Yeah, good afternoon, everyone. Today is the 7th day, which is a Sunday, August 2022. And today we'll be looking at much more soft aspect of group accounts. And we'll be looking at underlining theories, principles, and practices with respect to business combination vis-a-vis what necessitated the preparation of group accounts. And in doing so, we'll more or less make use of the resources, our material, our textbook, and which I'm using my Amazon copy. I believe some of you have the physical copy. And for those that have not yet gotten it from me, I'll more or less make it available to you guys during the week, as promised. Okay, now our discussion today will be on chapter 2 and chapter 3 of the material. And chapter 2 deals with much more fundamental understanding of business combination vis-a-vis the rationale of preparing group accounts. And we've also, in one way or the other, discussed some terminologies, which we've more or less come across in the past. Okay, in this slide, I'm going to much more provide some background information. Let me enlarge this screen. Okay, now the basic principles of group accounts. Our discussion across this chapter will introduce us to what constitutes group, the concept of group account, which we have more or less discussed before. And it will also allow the readers to appreciate the need to prepare group accounts, because not all business combination will require the preparation of group accounts. And also, participants here will subsequently be exposed to basic terminologies required for the purpose of preparing group accounts. Furthermore, the rationale for preparing group accounts will be discussed along other basic accounting issues in the whole process of business combination and the requirements of IFRS 3. And furthermore, we'll discuss things about investment in subsidiaries, the right that will give investors power over an investee, including what brings about exemptions in the preparation of group account vis-a-vis when will a subsidiary be excluded from group accounts, okay, or from consolidation, as the case may be. And thereafter, we are going to wrap it up with contemporary issues that has one or two things to do with group accounts, and also discuss the basic principle of the accounting methodology for consolidation at the point of acquisition, which is the acquisition method, and steps that need to be taken, which have already started in preparing group accounts. And in discussing this, we'll discuss it based on what IFRS 3 says, what IFRS 10 says, and what separate financial statement requires with respect to a parent entity recognizing its investment in a subsidiary. Okay, now basic things we discussed earlier, which if you make reference to our earlier videos, you will have more or less a better appreciation of what we've discussed so far. Okay, and what we'll also be looking at beyond this, we've discussed the majority of all these terms, okay, which we are already using significantly, many of them, okay. But we'll start today's discussion extensively from the aspect of rationale for preparing consolidated financial statements. Okay, what are the reasons? What are more or less giving us basis to prepare group accounts? Why do we need to prepare group accounts? Okay, there are various reasons or objectives towards preparing group accounts. And one of those key, as highlighted, as follows: what may cause prepare group accounts, or what we consider the importance of presenting consolidated financial statements. One of it is that it allows us, or financial users of financial reports have better understanding of a parent undertaking, both of its own operations and of its interest in a subsidiary. Okay, and it allows us to view such performance as if they are of a single entity. Also, it allows us to, at a glance, have a better appreciation of the economic resources available to the group. Okay, because you find out that in consolidation, you find out that it's not just mere addition. Otherwise, you can always pick the two financial statements and just add the figures together. But as we have seen, and as we will see more, it goes beyond just adding figures together on a line-by-line basis, but it entails much extensively trying to show the true position with respect to economic resources and claims that the group has, as if is of a single entity. Similarly, for obligations as a single entity, thereby all of this will allow us to eliminate anything that we consider intragroup or intercompany transactions and balances. All because if the parent and subsidiary are dealing with one another, therefore, invariably, it's still one entity. Such should not account for, we should not account for such as part of transactions that have been taking place within the group. And likewise, it allows to show results of a group as achieved by the resources employed collectively as a group. Okay, and people have believed that prepared group account is much better to make people have a better appreciation of the true position of a group in which all possibility of duplicated sales as a result of intra-group transactions and everything are already eliminated, thereby not giving room for fictitious transactions and the likes. Okay, and it also allows us to best measure the capacity and the performance of the parent, all because the parent has a stake in subsidiary, which means from the parent perspective, we can measure its true capacity beyond just its own individual financial statements. More meaningfully, when it comes to carrying out performance measurements, one of those key measures of performance, especially with respect to capital market operation, is the earnings per share. Now, in doing this, it allows us to have a true reflection of the earnings per share of the group as a whole, regardless of the number of entities that culminated into that group. And these are few reasons or factors that necessitated the preparation of group accounts. But in reality, it goes beyond this. Okay, and secondly, we'll be looking at basic accounting issues in business combination. And these accounting issues are majorly related to the primary objective of financial reporting, whereby we talk about ability of presenting financial information for the users of financial reports in making decisions. And we can categorize those activities into what I'll call RMD. The R stands for recognition, the M stands for measurement, and the D stands for disclosure, which also encompasses presentation. Now, in this case, you will find out that the major accounting issues affecting business combinations and also in the course of preparing group account more or less pertain to one or two or more of the following. The first aspect we look at is the proper recognition and measurement of assets and liabilities of the combined entities as a group. Okay, the second aspect is ability of us to be able to identify and recognize where necessary any goodwill, positive or negative, or goodwill and gain of bargain purchase that arose from the business combination. And also, thirdly, which we have not yet come across, is the principle of trying to eliminate intercompany or intra-group balances in order to actually reflect a true economic entity, being a single unit. Okay, and the fourth thing we'll also consider is the manner of accounting and reporting of non-controlling interest. As you are aware, non-controlling interest constitutes the interest in a subsidiary or within the group other than that of the parent. And we are more or less familiar about the requirement of IFRS 3, which requires non-controlling interest to be measured either at the proportionate share of the identifiable net asset of the subsidiary as acquired, or at the fair value of the acquired number of ordinary shares that the non-controlling interest owed in the subsidiary. Now, another thing we also need to discuss is the objective of IFRS 3 with respect to business combination. Now, I'll read as thus that the overriding objective of the new standard is to improve the relevance, representational faithfulness, transparency, and the comparability of information provided in financial statements about the business combinations and their effect on the reporting entity by establishing principles and requirements with respect to how an acquirer in its consolidated financial statement will do the following. One, how it recognizes and measures identifiable asset acquired, the liability assumed, and any non-controlling interest in the acquiree or in the investee, if any. And the what if any infers that non-controlling interest only exists when you have other shareholders other than the parents within the group. Okay, and also two, recognize and measure acquired goodwill or gain arising from a bargain purchase transaction. And three, ability to determine the nature and extent of disclosures sufficient enough to enable the users of financial report to evaluate the nature of the business combination and its respective and related financial effects. Okay, another thing we'll consider is how to account for and report non-controlling interest in a subsidiary, which has become a recurring decimal of accounting for non-controlling interest as a separate equity component, okay, which can either be measured at the proportionate share of the identifiable net asset of the subsidiary as at acquisition, subject to attribution of profit or losses post-acquisition, or to be measured at fair value at acquisition, subject to its participation in the post-acquisition profit or loss based on the performance of the subsidiary. And lastly, the consolidating its subsidiary when we cease to have a controlling interest. I will speak to that probably in a short while, where we will state the reasons or the rationale towards excluding a subsidiary from consolidation. And we'll see in that situation why we need to exclude a subsidiary from consolidation. Majorly, which means exclusion of subsidiary from consolidation infers that at what point do we cease to consolidate a subsidiary, if any? And all of these are things that we need to have at heart, which I consider as soft principles. Now, also we discussed extensively what control entails. As I've explained earlier, there are two perspectives to which we can view control, but the main perspective is the perspective of the current IFRS 3, which speaks to the three key attributes with respect to the power an investor has over investee. Secondly, with respect to exposure that the power will give, or right, the power will give to the investee to have access to the variable returns of the investee. Of the investor having access to variable return of the investee, and also having to demonstrate that there's a link as established by the fact that the power are extensively used to influence or affect the amount of returns the investor will derive from the investee. Okay, but before now, the word control was measured prior to now, before the revision that took place in 2008, it was defined extensively with respect to the power that an investor has over an investee, and this power entails power to govern both the financial and operating policies of the investee at any point in time. Okay, I want somebody to read this out for us to have also bigger view of the position of this standard. Okay, who will volunteer to read? Somebody with a less noisy background and a good network. Who will volunteer?
Okay. Is it the old view, sir?
Now start from investment in subsidiaries.
Okay. The important point in investment in subsidiary entities is control. IFRS 10 states that control can usually be assumed to exist when the parent owns more than half, that is over 50% of the voting power of an entity, unless it can be clearly shown that such ownership does not constitute control, which is rare. Though an investor controls an investee if and only if the investor has all of the following: power over the investee, exposure or rights to variable returns from his involvement with the investee, and the ability to use its power over the investee to affect the amount of investors' return. Now, old view of control. IS 27 reversed in 2008 states that control can usually be assumed to exist when the parent owns more than half, that is over 50% of the voting power of an entity, unless it can be clearly shown that such ownership does not constitute control. These situations are rare. IS 27 reverse 2008 lists the following situations where control exists, even when the parent owns only 50% or less of the voting power of an entity. A, the parent has power over more than 50% of the voting rights by virtue of an agreement with other investors, e.g. voting trust arrangements or other contractual provisions. B, the parent has the power to govern the financial and operating policies of the entity by statute or under an agreement. C, the parent has the power to appoint or remove the majority of members of the board of directors or equivalent governing bodies. D, the parent has the power to cast a majority of votes at meeting of the board of directors. IS 27 reverse 2008 states that in ascertaining whether control is present or whether the reporting entity is to be regarded as a parent company, and should therefore prepare the present a consolidated financial statement. The parent's potential voting rights in the subsidiary should also be considered alongside the actual voting rights. If the existence and effect of the potential voting rights are currently exercisable or currently convertible, the existence of potential voting rights or interests may exist due to the existence of options, warrants, convertible securities, debts or shares, or a contractual agreement to acquire additional shares, including shares that the investor or parent entities may have sold to another shareholders in the subsidiary or to another party with a right to contractual agreement to reacquire the shares, transferred at a later date, but the potential voting right should not be taken into consideration when determining what fraction of the subsidiary's profit or loss, income and expenditure is allocated to the parent company. IS 27 reverse 2008 also states that a parent lost control when it loses the power to govern the financial and operating policies of an investee. Loss of control can occur without a change in ownership level. This may happen if a subsidiary becomes subject to the control of the government, court administration, or regulator, etc. in bankruptcy. Thank you.
Thank you so much. Thank you so much. You've said it all. Now, when you talk about power, the power we are making reference to, how do you obtain them? Okay, usually power is obtained by the fact that you have substantial voting right through your investment in ordinary shares, which stands for more than half of what is required in a company. But again, it also extends beyond that sometimes you might not have more than half of voting right, but you gain additional power from your involvement in the subsidiary with respect to key management personnel, with respect to kind of transactions you more or less carried out because of such relationship, with respect to the representation you have in the board of that company. For example, a 7-man board in which you appoint 4 or you can remove more than half of that board member, even when you don't have more than half of voting right. It's also to show that you have this right that has given such a power, vis-a-vis other aspect of it. Now, I want someone to more or less look at this from this angle. Janet, if you have a less noisy background, can you more or less take this up to read more about the right that gives an investor power over an investee?
Okay, sir. Right that give an investor power over an investee. Power arises from right. To have power over an investee, an investor must have existing rights that give the investor the current ability to direct the relevant activities. The rights that may give an investor power can differ between investees. Examples of rights that either individually or in combination can give an investor power include but are not limited to rights in the form of voting rights or potential voting rights of an investee, right to appoint, reassign, or remove members of an investee key management personnel who have the ability to direct the relevant activities, right to appoint or remove another entity that directs the relevant activities, right to direct the investee to enter into or veto any changes to transactions for the benefit of the investor, and other rights such as decision-making rights specified in a management contract that give the holder the ability to direct the relevant activities. Technical notes: IFRS 10 technically no longer use the basis of voting rights as a precondition for ascertaining existence of control, which depicts that mere holding more than 50% of the voting rights may or may not provide control over the investee, and holding less than 50% of the voting rights, minority activity interest in an investee may provide control once the conditions established above are met. IFRS 10 also states that an investor does not have power over an investee, even though the investor owns the majority of the voting rights in the investee, when those voting rights are not substantive. For example, an investor that has more than half of the voting rights in an investee cannot have power if the relevant activities are subject to direction by a government, court, administrator, receiver, liquidator, or regulator.
Now,
Consolidated.
we've discussed this extensively, and which also depicts itself in what we read. Now, let's now look at the consolidation principles we have been applying. What formed that basis according to our discussion before now, and what is the theoretical background to that? Can you take it off from there? Consolidated financial statement.
Consolidated financial statement. This is the financial statement of a group, parent and subsidiaries, presented as those of a single economic entity. It is expected that a parent company prepares and presents consolidated financial statements that incorporate the financial statements of all its subsidiaries, both foreign and domestic. The basic consolidation procedures to be followed in order to prepare and present the consolidated financial statements of a group entail to A, combine like items of assets, liabilities, equity, that is, those attributable to post-combination transactions and events, income, expenses, and cash flows of the parent with those of its subsidiaries. B, offset, eliminate the carrying amount of the parent's investment in each subsidiary and the parent portion of the equity of each subsidiary. IFRS 3 explains how to account for any related goodwill, which will be discussed in the context of this text as at acquisition date. C, eliminate in full into a group assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group, profits or losses resulting from intra-group transactions that are recognized in assets, such as inventory and components of non-current assets, are eliminated in full. Intra-group losses may indicate an impairment that requires recognition in the consolidated financial statement. IAS 12 income taxes applies to temporary differences that arise from the elimination of profits and losses resulting from intra-group transactions.
Yeah, thank you very much. Thank you very much. Thank you very much.
Thank you.
Now, that speaks to why we are doing what we're doing before now, which you have equally explained. Now, the other aspect to look at it is this. Can there be an exemption where a company that has subsidiary or subsidiaries will not necessarily be required to present group accounts? That is, under what condition will a parent company decide not to prepare group account, even when there's a control and it just decided that it need not present to the public group accounts? Okay, now there are 4 critical conditions that the standard identify. And unless all of these 4 conditions exist, such a company would not be required to present group accounts. Therefore, I will allow, who can I allow now? Probably Mr. Adeni, are you there? Can you take us through the exemption principle of a parent being required not necessarily to present group accounts to the public? Okay, are you there? Okay, if not, okay, Esther, can you,
Yeah, exemptions for preparing group accounts. IFRS 10 outline the circumstances in which a consolidated financial statement should be prepared for a group considered a single economic unit, which is stated as though an entity that is a parent shall present consolidated financial statements. IFRS 10 applies to all entities, except a parent need not present consolidated financial statement if it meets all of the following conditions. 1, it is a wholly owned subsidiary or a partially owned subsidiary of another entity, and all these other owners, including those not otherwise entitled to votes, have been informed about and do not object to the parents not presenting consolidated financial statements. 2, its debts or equity instruments are not traded in the public markets, a domestic offering stock exchange, or an over-the-counter market, including local and regional markets. 3, it did not file, nor is it in the process of filing its financial statement with a securities commission or other regulatory organization for the purpose of issuing any class of instrument in a public market. 4thly, its ultimate or any intermediate parent produce consolidated financial statements that are available for public use and comply with IFRS. Thank you, sir. Or should I go ahead?
Yeah, okay. Before you go ahead, let me also introduce something. Now, in addition to what you've shown up there, which I'm going to explain, also, if a parent is considered to be an investment entity, okay, which we are going to explain what it means, such will not be required to present a group account, okay? And later on, we'll ask ourselves, what constitutes an investment entity, okay? And once you are an investment entity, as a parent, you have the option either not to present group account or to present a group account. And I'll tell you why. But before then, let me explain what you just read. Okay, now the first condition there is that if you are a subsidiary, whether partly or only owned subsidiary of another company, you will not necessarily be required to present group account if that company, who is your own ultimate parent, present group account in line with IFRS. What it means is that if company P controls company S and company S controls company A, now company S is you, and company S ought to consolidate company A and produce group account. But company S may not necessarily need to do that if company S itself is a subsidiary of company P, and company P will surely present group accounts in IFRS format or based on IFRS. In that situation, company S, which is a subsidiary of P, but a parent to A, may not proceed to present group what account. Now, in addition to that, it's not just straightforward. This is provided company S itself is not a quoted company. Okay? If company S is a quoted company, that exemption does not apply to company S. But if company S is just a limited liability company, not a PLC, it may allow for exemption. Also, even if it's not a quoted company, but if company S has any of its instruments quoted, for example, he has commercial paper in the capital market, or he has bond in issue in the capital market, therefore, in that case, he's already exposed to capital market, or what we call public market for financial reporting purposes. Therefore, he will not be exempted. Thirdly, even when it's not quoted in the capital market or does not have its instruments in the capital market, it will not be exempted if it's in the process of getting listed or is in the process of filing returns to the Security and Exchange Commission or similar institution as a prerequisite to getting listed or getting funds from the market. In that case, such exemption will not be applicable, which means for it to be applicable, it's not enough that you are a subsidiary that has a parent that prepared group account, is that also you does not have your instrument quoted in the capital market, and you are not also in the process of filing any returns in the short possible period of 3 months or more, or let me say within a year. And likewise, your ultimate parent complies with IFRS. Okay, once you have all of those conditions, that is only when you as a parent entity may not or need not present group what accounts. Now, the second layer I'm trying to discuss on is the aspect of investment entity. Now, investment entity are like special purpose vehicle for capital market investment. And an investment entity will not necessarily be required to present group accounts, okay? Or because it's not necessarily an operational entity, but a vehicle for putting funds solely for the purpose of investing. But let's look at what does the standard says, or how does the standard define or connote what an investment entity is. Now, I've more or less switched to IAS Plus. Okay, IAS Plus is also a resource base where they tend to disseminate and delineate standards and some clarifications for people to have better appreciation. Now, let's look at the definition of an investment entity. Okay, an investment entity is an entity that A, obtains funds from one or more investors for the purpose of providing those investors with investment management services. 2, they commit to the investors that its business purpose is to invest funds solely for return of capital appreciation, investment income, or both. And 3, they measures and evaluate performance of substantially of all the investment on a fair value basis. Now, a typical example of these investment entities are entities that might serve as an hedge fund, exchange traded funds, mutual trust funds, unit trusts, and some other investment management entity like that. Okay, and which we need to take note of. These entities may not necessarily present group accounts if the investment, by virtue of the investment strategy, gives control in any of the investment entities. Which means, if, for example, a mutual fund has like more than half voting right in a bank, such mutual fund would not be required necessarily to consolidate that bank, all because it's an investment vehicle. And for it to be an investment vehicle, first, it must not be one investor or two, it must be a multiplicity of investors whereby they put funds together in order to invest in capital market operation towards harnessing returns by way of capital appreciation or by way of investment income or both. Okay, in that case, you can more or less come back to more or less take us through the position of the standard with respect to investment entities, exemption from consolidation. Over to you. Yes, sir. Okay. Continue from where you stop.
Okay, sir. Technical notes. A parent that does not present consolidated financial statement must comply with IAS 27 reverse rules on separate financial statements. Investment entities consolidated exemption. IFRS 10 contains special accounting requirements for investment entities where an entity meets the definition of an investment entity as it is below. It does not consolidate its subsidiaries or apply IFRS 3 business combination when it obtains control of another entity. The investment entity consolidated exemption was introduced by investment entities issued on 31st October 2012 and effective for annual period beginning on and after 1 January 2014. An entity is required to consider all facts and circumstances when assessing whether it is an investment entity, including its purpose and design. IFRS 10 provides that an investment entity should have the following typical characteristics. It has more than one investment. It has more than one investor. It has investors that are not related parties of the entity. It has ownership interest in the form of equity or similar interest. Is there anyone down? Maybe we should go down.
No, continue.
Okay. IFRS 10 consolidated financial statement established principles for the.
Now continue from here, the absence.
The absence of any of these typical characteristics does not necessarily disqualify an entity from being classified as an investment entity. An investment entity is required to measure an investment in a subsidiary at fair value through profit or loss in accordance with IFRS 9 financial instruments or IAS 39 financial instrument recognition and measurement. However, an investment entity is still required to consolidate a subsidiary where that subsidiary provides service that relates to the investment entity's investment activities. Because an investment entity is not required to consolidate its subsidiary, intergroup related party transaction and outstanding balances are not eliminated. Special requirements apply where an entity becomes or ceases to be an investment entity. The exemption from consolidation only applies to the investment entity itself. Accordingly, a parent of an investment entity is required to consolidate all entities that it controls, including those controlled through an investment entity subsidiary, unless the parent itself is an investment entity. Should I go ahead? Exclusion of the subsidiary from consolidation.
Okay.
Thank you.
Now, we also now look at, is it possible that where a parent company has two or more subsidiaries, is it possible that we can find ourselves in a situation where the parent has 4 subsidiaries and decided to only consolidate 3 of them, leaving out only 1, which means it consolidated 3 subsidiaries, leaving 1 subsidiary unconsolidated. How possible is it? And on what point or on what basis will ever a subsidiary be excluded from consolidation? Now, prior to now, before the revision to the standard, far back 2008, there are various reasons and rationale, about 4 of them, which triggers the reason why a subsidiary can be excluded from consolidation. One of those reasons is where we say the business of the subsidiary is totally different from that of the parent. And therefore, because of the dissimilar activities, we claim that it will not necessarily provide a basis for reasonable understanding of the financial statement on consolidation. Okay, one other basis we used then was that when control was held temporarily, and control is held temporarily in a situation where you acquire that subsidiary with the intent of refurbishing it, revitalizing it, and to immediately sell it, which means it's not a subsidiary in which you have a long-term strategic plan for. It's a subsidiary whereby you take opportunity of a struggling entity and you bring it back to shape and you more or less exit through various strategy of IPOs and some other things to more or less push out to the public and sell. Or sometimes where a subsidiary, and this is common where you have a foreign operation. When you have a foreign subsidiary, for example, a subsidiary you have in Nigeria, and the parent company is in US. But because of challenges, regulation, and some other economic issues, there are restrictions, whether impliedly or expressly, that find it difficult for the Nigerian subsidiary to repatriate funds to its parent in US. Similar to what is happening now, I believe some of you are aware of various communications, especially the letter that was written by Emirates to say they are going to reduce the number of flying hours and flights to Nigeria in and out because they have about $85 million unable to be repatriated because of inability to access dollar in the open window and all sorts of things. Therefore, on that basis, probably a subsidiary might be under a severe long-term restriction to repatriating funds, and on that basis, you say, okay, we can't consolidate because we presume that control is not intact and some other things like that. All of these reasons are now nullified, are no longer permissible, all because there are various contentions and superior argument over them. One of them is that if you say the activities of a subsidiary is slightly different from that of the parent, okay, IFRS 6 takes care of that. IFRS 6 deals with operating segments, whereby you have different segments or different business lines. You can use IFRS 6 as a means to providing suitable, reliable information to the users of financial report as regards the affairs of the subsidiary, that its activity is so dissimilar to that of the parent or others. And another one is where there's a severe long-term restriction. No matter how severe it is believed that you rather more or less take a strong action or decision to more or less dispose of the subsidiary or take up other strategy to mitigating all of those things, which means control is not necessarily lost due to long-term restriction, okay? And therefore, you can't use that as an excuse to exclude the subsidiary from consolidation. Likewise, you can't use the excuse of temporariness with respect to holding a subsidiary. And that's why IFRS 5 exists. IFRS 5 borders on non-current asset held for sale and discontinued operation. In a situation where if you have a subsidiary that you have just acquired with the intention of disposing of in the next 12 months or the likes, therefore such will still be consolidated, only that we will also be adopting the approach of IFRS 5 with respect to the presentation. It will be disclosed within the consolidated account as a component of non-current asset held for sale, and likewise the liability disclosed within the non-current asset held for So liability section. And when we get to IFRS 5, probably you have a better appreciation of what we're talking about. Therefore, what then is the only basis to which a subsidiary can be excluded from consolidation? The only reason that a subsidiary will be excluded from consolidation is when control of that subsidiary has been lost. That is, it's only when you have actually lost the control of that subsidiary. And when you lose control of subsidiary, as I said earlier, you lose it as a result of partial or full disposal. And you can also lose it by way of court intervention when it's subjected to the control, or let me say, subjected to the directions and regulations strictly of government, of court, administrator, liquidator, or regulator. Okay, as we have discussed earlier. Okay, that is only when you can exclude a subsidiary from consolidation. But there's another reason why we might exclude, which precedes the conclusion we just reached earlier, is that if a subsidiary is considered not to be material, which means the subsidiary is immaterial to the group, there might be one or two justifiable reasons as an exception to consolidating such a subsidiary. Let me give you a practical example. Imagine we have 5 subsidiaries, and the parent and the other 4 subsidiaries, excluding one subsidiary, account for about 99% of the economic resources and the obligation of the group upon consolidation in the most recent time. But we have the 5th subsidiary, due to one reason or the other, probably due to challenges where account may not be available, or to one factor or the other that we might not preempt, and waiting for such a subsidiary to have its account completed before it is published as a group, we outweigh the benefit of reporting because we talk about timeliness. Therefore, we can proceed to consolidating other 4 subsidiaries and leave out the 5th subsidiary because of immateriality. But these have to be disclosed for people to have a better understanding and appreciation. And also for comparability's sake, it might be necessary to also show the report of the comparative period, excluding that same subsidiary, if practicable. And in that situation, it means that apart from immateriality, the main and the only basis to excluding subsidiary from consolidation is through a situation where the control of that subsidiary has been lost. And the control of the subsidiary is lost if you have partially or only disposed the shares or your stake that gives you control in the subsidiary, or where such subsidiary is now subject to the intervention of a court, of a government, of the regulator, or of a liquidator, or as filed for bankruptcy protection. And that is that. Now, let's find someone to summarize all what I've discussed so far with this lectures. Who will volunteer? I believe, Mr. Anthony, your device is better now. Can you assist us and let us see whether there will be noise from your device? Mr. Anthony, are you there? Okay, Samuel, I hope your network is better today.
Sir, I'm in a meeting, sir.
Samuel, I can hear you. Are you there? It seems your network is poor. Okay, Janet, can you take it over?
Okay. Can you hear me now? Can you hear me now?
There's a noise
Yes,
at
sir.
your
Can you
background.
hear me now? Can you
There's a
hear me
noise.
now? Okay.
Okay. Continue,
Hello.
Samuel. Continue, Samuel.
Hello.
Yeah, we can hear you. I can hear
All
you.
right. All right, sir. Exclusion of a subsidiary from consolidation. The rules on exclusion from consolidation have been strict based on IFRS 10. The subsidiary can only be excluded from consolidation only on the basis of actual loss of control. The standard does not consider other bases as contained in the previous IAS 27 before its revision in 2008. An ultimate replacement where control is intended to be temporary view to its disposal within 12 months will probably meet the condition in IFRS 5, non-current asset held for sale and discontinued operations, for classification as held for sale. The implication is that such investment will not be accounted for under IFRS 10, but rather under IFRS 5, which implies that all of its assets are presented as a single line item, below current liability. By so doing, the subsidiary is still consolidated. Subsidiary is still consolidated, but in a different way. On the grounds of the similar activities in the past, argument has been made that subsidiaries should be excluded from consolidation. The ground of the similar activities, that is, where the activities of subsidiary are so different to the activities of the other.
Janet, can you continue from on the ground of the similar activities?
Okay. On the grounds of the similar activities, in the past, arguments has been made that subsidiaries should be excluded from consolidation on the grounds of the similar activities. That is, where the activities of the subsidiary are so different to the activities of the other companies within the group, that to include it result in the consolidated financial statement will be misleading. The exclusion on this ground is no longer acceptable and justifiable, as a group should consolidate the subsidiary results, and then this will be explained by the segment information required by IFRS 8 segment reporting. Under a severe long-term restriction, which significantly impairs subsidiary inability to transfer funds to the parent, the standards further posits that mere severe long-term restriction on the ability of the parent to manage a subsidiary does not require outright exclusion. Rather, such exclusion will only be permissible when such severe long-term restriction results in actual loss of control. That is, control must actually be lost for exclusion to occur. Technical note: invariably, subsidiary will be excluded from consolidation only when control is lost, and or if its consideration will be deemed to be immaterial to the entire group operations and accounts. I'm done, sir.
Okay, that is that. Now, any questions so far?
Sorry about that, sir. My network actually.
Yeah, I understand. Yeah, I understand. Yeah, okay. Thank you very much. Thank you very much. Now we are now going to look at contemporaneous issues, or what I call contemporary issues. These are salient issues, key issues that underlines all what we are doing and what we still do more with respect to group accounts. And what the approach I'll take is that as you guys read one terminology, the expression of it, I will explain what it entails. Okay, we have about close to 26 of them or less, and some of them we are familiar with them, but those key other ones that need me to buttress, I'm going to do that. Okay, who will volunteer at this time to start with A and B? You take two at a time, okay?
Contemporary issues in group accounts. A, potential voting rights. The existence and effects of potential voting rights, including potential voting rights held by another entity, should be considered when assessing whether an entity has control over another entity and therefore has a subsidiary. In assessing whether potential voting rights give rise to control, the entity examines all facts and consequences and circumstances that affect the rights, e.g., terms and conditions, except the intention of management and the financial ability to exercise the rights or convert them into equity shares. When assessing control, an investor considers its potential voting rights as well as potential voting rights held by other parties to determine whether it has power. Potential voting rights are rights to obtain voting rights of an investee, such as those arising from convertible instruments or options, including forward contracts. Those potential voting rights are considered only if the rights are substantive. When considering potential voting rights, an investor should consider the purpose and design of the instruments, as well as the purpose and design of any other involvement the investor has with the investee. This includes an assessment of the various terms and conditions of the instruments, as well as the investor's apparent expectations, motive, and reasons for agreeing to those terms and conditions. If the investor also has voting or other decision-making rights relating to the investee's activities, the investor assesses whether those rights, in combination with potential voting rights, give the investor power. B, acquisition-related costs. The original IFRS 3 in 2003 required fees, legal, accounting, valuation, etc., paid in relation to a business acquisition to be included in the cost of investment, which meant that they were measured as part of goodwill. Under the revised IFRS 3 in 2011, costs relating to the acquisition must be recognized as an expense at the time of the acquisition. They are not regarded as an asset. Cost of issuing debt or equity are to be accounted for under the rules of IAS 39 or IFRS 9, where earlier adopted, and IAS 32 respectively. Acquisition-related costs are costs the acquirer incurs to effect a business combination. Those costs include founders' fees, advisory, legal, accounting, valuation, and other professional or consulting fees, general administrative costs, including the cost of maintaining an internal acquisition department, and cost of registering and issuing debt and equity security. The acquirer shall account for acquisition-related costs as expenses in the periods in which the costs are incurred and the services are received, with one exception, which is the cost to issue debt or equity securities shall be recognized in accordance with IAS 39 or IFRS 9, where earlier adopted, and IAS 32 respectively. Technical note, all expenses, including that of a professional accountant and solicitor to the business combination, are to be written off as incurred. However, IFRS 3 and IAS 32 require the cost of issuing equity to be treated as a deduction from the proceeds of the equity issue. Share issue cost will to be debited to share premium account. Issue cost of financial instruments are generally deducted from the proceeds of the financial instruments.
Thank you very much. Thank you very much. Now, let's take it one by one. Now, what is potential voting right? These are rights that are likely going to come up in the immediate future. Let me say from tomorrow or next. But they do not constitute part of the existing rights that initially we were using to determine whether control exists or not. Existing rights are rights attributable to the number of ordinary shares you hold currently. Now, we are not saying that, what if I owe 45% currently? And that 45% naturally, without any other thing, cannot give me control because of the structure or pattern of ownership. Probably we are just 5 shareholders. I have 45, another person has 20, another person has 25, 10, 15, like that. Which means I might not be able to control except I partner with another person to have more than 50, or in a situation where others are so minute in terms of shareholdings and we have them scattered around. But naturally, if I have 5 we have 5 shareholders in a company in which I have 40% or 45, and I'm not able to strategically enter into an agreement with another shareholder to make me scale more than half of the right, and I'm not be able to control. But it's because I have limitation with my existing right. But there's also a possibility that I already have a contractual agreement with the company such that in the immediate future, if it crystallizes, we have access to exercise my option towards getting more shares that will now make me cross from 45 to 50 and above, or a situation where I have convertible security. For example, the company has bond that has also been issued, and those bonds are convertible to ordinary shares in the immediate future. And I have a stake so that if they become converted in the future, it will take me from 45 to like 51%. Therefore, on that premise, that potential voting right will be considered alongside my existing rights to determine whether there is a control, even when I've not crossed the threshold. And that is the whole essence of potential voting rights. The second aspect deals with acquisition-related costs. And what that is trying to explain to us is that when we say you buy a company, if you buy a company for 50 million naira, you can't just assume that you wake up, you approach the company, you agree, you pay, and you move on. No. Mere conceptualizing that I want to buy a company will require some engagement, will require some due diligence, will require some other auxiliary services, which comes at a cost. Some of them are due diligence, legal fee, consulting, and etc. Even mere getting close to the transaction closure, where you are already engaging with the target company, you also incur costs. And even after you incur costs. Now, all of these costs that we call acquisition costs, be it administrative, professional, advisory, consulting, finance, legal, and incidental costs, all of them can be subgrouped into for our discussion. The 3 grouping will be administrative and professional services, which means all costs relating to consulting, advisory, accounting, and the likes, they will fall under administrative and professional fee. And the treatment to be accorded this cost is to expense them because they play no role by way of creating economic resources. They are just incidental costs in such a way that you can't acquire a company without trying to carry out due diligence, even though you might decide not to do that and go ahead. But the question is that those relate to nothing other than administration. And in that case, such costs have to be expensed or charged to the profit of the parent. Which means that on no basis can you capitalize such a cost. Which means if you pay 50 million to the former owners of the company, but you have incurred 2 million naira in all this legal accounting advisory fee, you can't say you acquired the company for 52 million. No, you have acquired the company for 50 million and you have incurred 2 million naira professional fee, which you have expensed in your profit or loss. Which that means that peradventure you come across a question where they have already capitalized it. Therefore, what you then need to do is to correct for that error by more or less removing the 2 million out of that cost and charge it to the expense straightforward. Okay, that is the first level. The second level is, what if the acquisition entails share exchange? We are going to come later to discuss about what are the forms of consideration in an acquisition. Now, if it involves share exchange, which means instead of you paying cash to the former owners, you are issuing shares in exchange for the shares acquired in the target company. In that case, when it comes to issue of shares, there are incidental costs to issue. First, you need to register shares that have been newly issued with the corporate affairs. Okay. Two, you need to pay taxes like stamp duty and some other costs relating to that issue, including regulatory costs, if any. All of those costs incidental and instrumental to you issuing shares as a result of that acquisition, which comes by way of the exchange of shares for shares. It then means that such costs, how do we treat them? Such issue costs on issue of shares will be treated in line with the requirement of IAS 32. And when we get to financial instruments, we'll more or less delve into it further. But in the preliminary discussion, IAS 32 recognizes that any proceeds from issue of shares should be taken as a deduction from the share proceeds. What it simply means, for short, is that if you issue shares for 50 million and you incur 1 million naira by way of stamp duty, corporate affairs registration fee, and all sorts of things for 1 million naira, therefore, you will consider invariably or impliedly that the proceed you raised from the issue of shares is 49 million, which means it's 50 million less the 1 million you incur in order to get the 50 million. Therefore, how do we do that in reality? Is that the 50 million goes, a component of it goes to the share capital account, and the other components above the nominal value goes to the share premium account. Now, when you now incur 1 million, that 1 million will be charged against your share premium. Okay, rather than being expensed, it will be charged directly to equity, to share premium. And peradventure, you don't have a share premium account, or because the shares are issued at par. Therefore, the 1 million naira being the issue cost will be charged directly to retain earnings or any other acceptable reserve that may exist in your capital structure as at that point in time. Now, the third aspect is, what if we are not doing share exchange, or we have done share exchange and we have accounted for it appropriately? And what if we don't have transaction costs, or we have and we have done it appropriately, but the money we had to acquire the company were borrowed, which means we issue bond or we borrow from bank in order to have access to funds for acquisition. Now, the incidental cost of borrowing, I'm not talking of borrowing cost now, I'm talking of incidental cost of borrowing, like management fees. Okay, management fees or any other fee related to the life cycle of that borrowing that you must have paid ab initio or ahead will not be taken as an expense. Rather, it will be taken as a reduction of the proceeds from that borrowing. What it then means is that once you borrow 50 million and you get 1 million naira, as management fee or any other fee we consider it to be. Such 1 million naira will be used to reduce the proceeds of that 50 million naira borrowing, which means effectively your value to recognize for that borrowing upon initial recognition will be the fair value of that borrowing, which is the 50 million, less the transaction cost, which is 1 million, which is invariably only administrative costs or professional costs you deduct in relation to the acquisition, while issue share costs you deduct against share premium or retained earnings. And when it comes to transaction costs with respect to borrowing towards acquisition, you use it to reduce in order to arrive at your amortized cost for that borrowing at that point in time. Only administrative cost is charged directly to profit or loss. And none of those three costs will be capitalized along with the cost of acquisition, which means cost of acquisition is the actual amount that is given or exchanged as a consideration for that acquisition with the former owners of the target or acquired entity. Okay, any question on that? If there's none, I want same person to read C, D, and E for us.
Asset.
Okay.
Can I continue?
Yes, you can continue.
Okay. Assets held for sale. The acquirer shall measure an acquired non-current asset or disposal group that is classified as held for sale at the acquisition date in accordance with IFRS 5, non-current assets held for sale and discontinued operation at fair value less cost of disposal. D, different reporting dates. It is expected that the subsidiary and parent entity have the same reporting date. But in the instance where the reporting dates are different, the parent can still consolidate the results of the subsidiaries by adjusting the results to effect necessary adjustments, provided the difference in reporting date is not more than 3 months. The financial statements of the parent and the subsidiaries used in preparation of the consolidated financial statement shall have the same reporting date. When the end of the reporting period of the parent is different from that of a subsidiary, the subsidiary prepares for consolidation purposes additional financial information as of the same date as the financial statements of the parent to enable the parent to consolidate the financial information of the subsidiary unless it is impracticable to do so. If it is impracticable to do so, the parent shall consolidate the financial information of the subsidiary using the most recent financial statement of the subsidiary adjusted for the effects of significant transactions or events that occur between the dates of those financial statements and the dates of the between the date of the subsidiary's financial statement and that of the consolidated financial statement shall be no more than 3 months, and the length between none, sir. Hello, sir.
Can you hear me? Okay, can you speak?
No, sir.
Yeah, you finish different reporting dates. Can you look at the uniform accounting period and date of inclusion?
Yes,
I'll look at all of them together, okay?
Okay, sir. The uniform accounting policies. A parent shall prepare policies for this. The parents and the subsidiaries are expected to have the same accounting policies. And in the absence of uniform accounting policies, it is expected that upon consolidation, the financial statements of the subsidiaries are adjusted appropriately to adjust the accounting policies of the parent before consolidation. Invariably, if a member of the group uses accounting policies other than those adopted in the consolidated financial statements for like transactions and events in similar circumstances, appropriate adjustments are made to that subsidiary's financial statements in preparing the consolidated financial statement to ensure conformity with the group's accounting policies. F, date of inclusion to exclusion. Consolidation of a subsidiary shall begin from the date the investor obtains control of the investees and ceases when the investor loses control of the investee. The results of subsidiary undertakings are included in the consolidated financial statement from the date of acquisition, that is the date control passes to the parent, to the date of disposal, that is the date control passes from the parent. So I'm done with this page, sir.
Yeah, thank you. Now let's pick it one by one. Now, as I've said, that because of the similar activities, it's not sufficient for us not to consolidate a subsidiary, which is we consolidate but disclose such dissimilar activities by way of operating segment. But again, in addition to that, we also said, because we own the subsidiary for a temporary period, it's not sufficient enough for us to not to consolidate, but rather we more or less consolidate the subsidiary in line with IFRS 5, which borders on non-current asset held for sale. And as I've said earlier again, this is just to refresh our memory, and we are going to discuss it extensively when we get to IFRS 5, where we're talking of non-current asset held for sale and discontinued operation. Now, the most important aspect here is the reporting date. Now, the reporting date of the parent and subsidiary is encouraged to be the same and should be the same, but is different from must be the same. Should be the same means that it is encouraged that they are the same in order to facilitate smooth and ease of consolidation and better appreciation and understanding of the financial results. Okay, but there are also situations whereby they need not be the same due to one factor or the other. And usually the excuse I can give from practical experience why they might not be the same is, for example, if the parents run accounting year based on its industry from April to March each year, but the subsidiary is a financial institution in which regulation, much more severe regulation in Nigeria, more or less mandated all banks to have common year end, which is from January to December, which that means that they have different reporting dates. That is still not a problem, provided the reporting dates are not far apart. And the threshold for measuring that not far apart is 3-month period, which that means that if the difference in the reporting date is no more than 3 months, you can still proceed to consolidating the parent and subsidiary. Like the example I gave, the subsidiary, which is a bank, has its year end in December, but the parent, which is a manufacturer, has its year end to be March 31st. Therefore, this is still within line. But again, in consolidating this, you must ensure that material transactions that may have occurred between that 3 months are adequately taken into consideration, accounted for, and necessary adjustment made, okay, in order to reflect the true position as at the reporting date of the parent, okay? Now, what if the reporting date differ by more than 3 months? It is practically rare to have such situation, but peradventure such situation exists. It then requires that we will be forced to consolidate the subsidiary by reconstructing his account first. Now, let me use my notebook to explain what I'm trying to say about reconstruction of the account. Okay, now let's look at it in this way. The parent's reporting date is from 1/1/2021 to 31/12/2021. Okay, now the subsidiary reporting date. Is 1/7/2020 to 30th June 2021, and he had just started a new year between 1st 2021 and is still at 31st of December 2021. Now, if I'm to do that now, let me draw the timeline so that I can see. This is the parent's own timeline. Now, this is the timeline of the subsidiary. The subsidiary is 1st of July 2020, and this 30th of June 2020. Now, if you look at it, where do they cut one another? They cut one another at this point.
2021.
Which means this is where they have something in common, are we? For the reporting date of the parent. Remember, reporting date of parent is what is sacrosanct in this situation as what we use for the group. Now, you find out that, let me say, this position here is audited, and this position here also has been audited. Now, but the parent have to report the group. The group is reporting at this date, which is the same thing as the parent. This is the group date, which is 1/1/2021 to 31/12/2021. Now, what that means is that we are taking the whole of 12 months of the parent, which coincide with the group. We are bringing it in here. I will be taking just from this period, which is 1st of January 2021, I will now come into the new year that is just starting for the subsidiary, which will cut across to this year. New year of the subsidiary is 1/1/17/2021, which will end 30th June 2022. Which that means that we also look at it. This period also cut across this period, which is by the time we have this like this, which means we take 6 months here, we take another 6 months here, which now runs 12 months along with other members of the group. Which means we take full-fledged the parent and we take 6 months of different reporting periods of the subsidiary to make up 12 months. From there, I can now consolidate so that everything now aligns within this box. Does it make sense to you guys? Does it make sense?
Yes.
Yes, sir.
Okay. That is it. Which means what is inside this box the account of the parent and subsidiary inside this box are what are consolidated, regardless of whether it falls partly to previous period and partly to the current or future periods. And that is what it means by reconstruction of the account of the subsidiary to align with that of the parents prior to consolidation. Okay, let's leave that, and also let's discuss extensively on uniform accounting policies. Now, another thing we need to assume is that the accounting policy of the parents and the accounting policy of the subsidiary should be the same.
I have a question, sir.
Yes, what's your question?
Yes, sir. As regard the subsidiary, since we are seeing that the subsidiary's accounting period was from July.
So your background, there's too much noise there. It's affecting. Can you send the charts, or you leave that place? The background is too noisy. Okay. Now, the accounting policy of the parent and subsidiary should be the same, and not necessarily must be the same. Should be the same means that before consolidation, we must ensure that they are the same, which means it will be nice for the parent and subsidiary to have the same accounting policy in the preparation of their individual financial statements. But the standard does not compel that it must. But should, in case they have different policies for one or two line items, before you consolidate, you must align those policies, which means if the policy of the parent is to carry PPE at cost, and the policy of the subsidiary is to carry at a valued amount. Okay, now let us assume that the policy of the parent is that of the group. It then means that before I can consolidate the financial statement of the subsidiary, I must ensure that I adjust the financial statement of subsidiary to bring the PPE and the respective depreciation effect back to what it will have been if they have adopted cost before I can consolidate, which means you must ensure as far as practicable, especially where they don't have uniform accounting policy, that upon consolidation, necessary adjustments are made to the account to align the policies before consolidation can take place. Now, the next aspect here is date of inclusion. Date of inclusion is synonymous to date of acquisition. What it simply means is that the date of inclusion is the first date in which you obtain control of a subsidiary. Now, remember that it might not be at once you make an acquisition. There's what we call piecemeal acquisition. Piecemeal acquisition means that you might have been acquiring company bit by bit. The first acquisition might be that you had 10% stake in a company. Over time, you grow it to 25%. And just yesterday, you've acquired additional stake that now make it 55%. Now, when have you acquired? The date of your acquisition is not necessarily when you have been acquiring 10%, 15%, no. It's the date that signify the final point of acquisition that make you gain control. And it is from that date you start to consolidate, which means the date of acquisition, which is date of inclusion, is where you start to consolidate, or because that was the first date in which you have obtained the control of the acquiree, which is the subsidiary. Whereas the date of exclusion is when you cease to consolidate a subsidiary, and which is synonymous to the date in which you have lost control, or the date you cease to consolidate a subsidiary, or similarly, the date of disposal. And that is when control has been lost. The first date in which you lose control, that date is where you last consolidate the subsidiary. Now, let me go back to Samuel. Samuel has been able to put up a question. He said, from the analogy, the residual 6 months are yet to be audited at the date of group consolidation. Would the group financial statement be true and fair? Now, the word audited I'm trying to say is that let us assume that the company only do final year audits. They don't do continuous audit or interim audit. It then means that it's only the parent that has financial audited account between 1st of January 2021 and 31st of December 2021. But the last audited account of the subsidiary will have been between 1st of July 2020 to 30th of June 2020. No, sorry, 2021. This 2021. 30th of June. Of June 2021. Okay, that is the only one that is audited. Okay, but this other one, remember we have assumed that you only do final year audit. This new year is still unaudited in principle if they do only final year audit. Which that means that in the process of doing this, nothing stopped the company, the parent, from getting a private audit or a statutory audit of 6 months. I remember the group auditor also have responsibility that it ensures that the consolidated account, that is the subsidiaries account, are equally audited and reviewed prior to this consolidation completion. And that's why issue of audit or not is very easy, which means you can't prepare a consolidated audited account without any component of it not being audited, which means you can always conduct an audit for this 6 months to give a certification about fair representation of the account therein, which means it's not an issue at all. I believe I've addressed that situation. Okay, now let's look further to other aspects. Okay. Now, attribution of losses. Esther.
Yes, sir. Attribution of losses based on the provision of IFRS 10, non-controlling interest can be negative by absorbing losses in essence of its share of the net asset in a subsidiary. This is consistent with the idea that non-controlling interests are considered investors of a separate class in the group, whereas in the previous IAS 27, before its revision in 2008 and subsequent replacement by IFRS 10, non-controlling interests could not be negative, as losses exceeding non-controlling interests were attributed to the parent and absorbed accordingly. An entity shall attribute the profit or loss and each component of other comprehensive income to the owners of the parent and to the non-controlling interest. The entity shall also contribute total comprehensive income to the owners of the parent and to the non-controlling interest, even if this results in the non-controlling interest having a deficit balance. Should I go ahead, sir? Accounting for subsidiaries controls entities and associates in the parent's separate financial statements. The parent is expected to show in its separate individual financial statements the investment in subsidiaries, jointly controlled entities and associates at fair value at initial cost, first acquisition, and subsequent remeasured based on IFRS 9, which include at amortized cost, fair value through profit or loss, and fair value through other comprehensive income, IAS 39, as applicable. Non-controlling interest, IFRS 10, allows two alternative ways of accounting for non-controlling interest in the consolidated statement of financial position upon acquisition. Non-controlling interest can be measured upon acquisition at its proportional share of the fair value of the subsidiary's net assets, full or fair value, usually based on the market value of the shares held by non-controlling interest. A parent shall present non-controlling interest in a consolidated statement of financial position within equity, separately for the equity of the owner of the parent. Non-controlling interest is not allowed to be presented in a mezzanine finance.
Mezzanine finance.
Okay, Medani sorry. That is presented between equity line and liability due to the fact that the group is now viewed as an economic unit in which non-controlling interest is an investor in the group. Changes in the parent's ownership interest in a subsidiary that do not result in the parent losing control of the subsidiary are considered equity transactions. That is, transactions with equity holders in their capacity as owner. Technical note. The option to value non-controlling interest at fair value is introduced by the reverse IFRS 3 in 2011, but it is just an option which a company can choose to adopt or to continue to value non-controlling interest at a share of net assets. The option is applicable to different business combinations.
Okay. Thank you very much. Now let's go back. Now what we are saying here is that there's a possibility that the subsidiary continue to perform poorly and start to make losses. Okay, and in that situation, if we continue to share the loss over time, there's a possibility that the loss will have eroded even the entire amount of non-controlling interest since acquisition, which means probably at acquisition, non-controlling interest was 100 million. Now we have shared loss over the last 5 years, so that the total loss we have shared to non-controlling interest is 120 million. Which means if you net off 120 million against 100 million of the investment of NCI, they are now negative of 20 million. Can we be allowed to show that negative NCI in our group account? The answer is yes, because they are also investors like us. Since my own equity can also go negative, so be it, their own investment can also go negative, and I have to represent that in my books. But before now, before 2008, we don't do that. The maximum exposure that NCI might have is 0, not negative those days, all because it is presumed that it's easy for NCI to walk away, which then means that any further obligation may be at the doorstep of the parent, if practicable. But under this current dispensation, equity, NCI is also a component of equity within the group, and therefore, the value of NCI can become negative, which means you won't be shocked when you are to consolidate and you find out that NCI is negative contribution to total equity instead of positive contribution to total equity. Now, with respect to accounting for assets and joint venture, we are going to discuss that in the next discussion today. But what we are trying to say is this: upon initial recognition, most items are measured at their fair value because the transaction price, what is being equal, is a representation of their fair value. But subsequently, they have the choice of remeasuring them, since it's equity, to measure them at fair value based on IFRS 9. Okay, but technically, you also find a situation where you might carry them at cost, which is part of an exception that is provided based on IAS 27. And we're going to look at IAS 27, which speaks to separate financial statements today, God's willing. Now, the last aspect here talks about non-controlling interest. It's no more news to us that non-controlling interest is a component of equity within the group, and we have two options to which we can measure them. The first one is that we measure non-controlling interest at the proportionate share of the identifiable net asset of subsidiary as acquired, whereas the other option is to measure it at fair value of the equity instrument, which is the number of shares held by the non-controlling interest at acquisition. But again, we also said that this option is available for different business combinations, which means, imagine 5 years ago, you acquire a subsidiary, you use fair value for the NCI. 2 years ago, you acquire another subsidiary, you use the same fair value. Today, you might acquire a subsidiary and decide to use proportionate share. The question is that each combination is a class of its own. They are never the same, which means you are not going to treat combination, each acquisition, as if it's like property, plant, and equipment that they are of the same class, that you say every building you buy within your property is the same class with existing building. Therefore, you can have different policy. But when it comes to business acquisition, remember, you are acquiring a business and there are different strategies to running different businesses. Therefore, each business you acquire is a separate class of its own that deserves its own unique accounting policy, which means it's possible that out of your 3 subsidiaries, Non-controlling interest in 2 are measured at fair value, while in 1 is measured at proportionate share. Okay, now I want somebody else to look at this also, take view of this, gain on bargain purchase and contingent consideration. Okay, Mr. Dini, over to you.
Yes, sir. Gain on the bargain purchase. Initially, goodwill arising from consolidation is different between the cost of combination, that is called cost of acquisition, and the fair value of the subsidiary's net asset acquired, which is positive. Or sometimes the difference can be negative, which simply shows that the cost of combination may be less than the fair value of subsidiary's net assets acquired. That is, the aggregate of the fair value of the separable net assets acquired exceed what the parent paid for them. IFRS 3 refers to this as the bargain purchase. IFRS 3 recommended the following upon recognition of gain from bargain purchase. A, an entity, that is parent, should first reassess the amounts at which it has remeasured both the cost of combination and the acquirees, that is investees' identifiable net assets. This exercise is expected to identify any error. B, any excess remaining should be recognized immediately as a gain in group profit or loss. K, contingent consideration. The revised IFRS 3 requires the acquisition date fair value of contingent consideration to be recognized as part of the consideration for the acquiree once it can be measured reliably. I.e., the acquirer shall recognize the acquisition date fair value of contingent consideration as part of the consideration transferred in exchange for the acquiree. The acquirer may be required to pay contingent consideration in form of equity or a debt instrument or cash. An equity instrument should be presented as under IAS 32, financial instrument presentation. Contingent consideration can also be an asset if the consideration has already been transferred and the acquirer has the right to receiving returns of some of it if certain situations or conditions do or do not exist. Some changes in the fair value of the contingent consideration that the acquirer recognizes after the acquisition date may be as a result of additional information that the acquirer obtained after that date about facts and circumstances that existed at the acquisition date. Such changes are measurement period adjustments in accordance with IFRS 3 as revised. However, changes resulting from events after the acquisition date, such as meeting an earnings target, reaching a specified share price, or reaching a milestone on a research and development project, are not measurement period adjustments. The acquirer shall account for changes in the fair value of contingent consideration that are not measurement period adjustments as follows. A, contingent consideration classified as equity shall not be remeasured, and its subsequent settlement shall be accounted for within equity. B, other contingent consideration that Roman figure 1 is within the scope of IFRS 9 or IAS 39 shall be measured at fair value at each reporting date, and changes in fair value shall be recognized in profit or loss in accordance with the standard. Roman figure 2 is not within the scope of IFRS 9 or IAS 39 shall be measured in accordance with the requirement of IAS 37 provisions and contingencies. Technical notes. The previous version of IFRS 3 only required contingent considerations to be recognized if it was probable that it will become payable and the consideration can be measured reliably. IFRS 3 revised dispenses with this requirement. All contingent considerations are now recognized. It is possible that the fair value of contingent consideration may change after the acquisition date. If this is due to additional information obtained that affect the position at the acquisition date, goodwill should be remeasured. If the change is due to events after the acquisition date, such as a higher earnings target has been met, so more is payable. It should be accounted for under IFRS 9 or IAS 39, where the consideration is in form of a financial instrument such as loan notes, or under IAS 37 as an increase in a provision if it is cash. Any equity instrument is not remeasured.
Thank you, sir.
You're welcome, sir.
Thank you, sir. Thank you. Now, we've discussed extensively gain on bargain purchase, therefore we don't need to repeat it, but this is just a fundamental discussion on what make us to do what we did those days. Now, also contingent consideration, I will not further explain it here, because today we are going to be looking at various forms of consideration, in which contingent consideration is one of them, and the accounting methodologies will also be discussed, which means I'll discuss contingent consideration alongside with deferred consideration and other form of cash and in-kind consideration, which are cash consideration, share consideration, and asset transfers, including debt consideration. We'll look at all of those ones possibly today. Okay, now let's fast track it and look at other aspects. I want somebody to volunteer. Shade, Madam Shade is here. Okay, can you volunteer for L?
Yes, I'm here. IFRS 3 and fair value of subsidiary net asset. The acquirer should recognize the acquiree identifiable assets, liability and contingent liability at the acquisition date only if they satisfy the following criteria. 1. In the case of assets other than an intangible asset, it is probable that any associated future economic benefit will float with the acquirer and its fair value can be measured reliably. 2B. In the case of liability other than contingent liability, it is probable that an outflow of resources embodying economic benefit will be required to settle the obligation and its fair value can be measured reliably. In the case of intangible assets or a contingent liability, its fair value can be measured reliably. The acquiree identifiable assets and liability must include assets and liabilities not previously recognized in the acquiree's financial statements. The fair value shall be regarded as the fair value of the initial recognition of a financial asset in accordance to IFRS 9, or when appropriate, the cost of initial recognition of an investment in an associate or joint venture. Restructuring and future costs. Liability for future losses or other costs expected to be incurred as a result of business combination should not be recognized by the acquirer. IFRS 3 explained that plan to restructure a subsidiary subsequent to its acquisition is not present obligation of the acquirer at the acquisition date. Neither does it meet the definition of a contingent liability. Invariably, an acquirer should not recognize a liability for such restructuring plan as part of allocating the cost of the combination unless the subsidiary was already committed to the plan before the acquisition. That's all.
Okay, thank you very much. Now let me speak about fair value. Now next week, which is the next session, we'll be discussing, part of what we'll be discussing is the fair value requirement as an acquisition, where we'll be mandated at acquisition to After identifying all assets and liabilities acquired and assumed, we must compulsorily measure all of them at fair value, so that anyone that have its fair value different from its carrying amount, such adjustment will be made as part of pre-acquisition adjustment. Okay, and we are going to discuss that extensively with practical demonstration of our understanding next week. Now, in addition to that, also, sometimes I think next week we will also discuss issues that borders on contingent liability, whereby contingent liability under IS 37 supposed not to be recognized as a liability, but rather it should be disclosed. But in respect to business combination, there are conditions that if met, which we are going to discuss later, contingent liability should be part of the liability assumed and identified and measured at fair value at the point of acquisition. But in doing so, we should be very careful that any future cost or cost towards commitment towards restructuring after such an acquisition takes place should not form part of any liability identified as at acquisition and should not be taken into consideration, which means restructuring costs, future costs relating to post-acquisition activities are not part of liabilities assumed as at the point of acquisition, or because you are not compelled to carry it out and it's not onerous on you. And that is what we are trying to say at that point in time. Okay, now let's look at indemnification assets and intangible assets. Who will volunteer here? Is Mr. Anthony still here? Can you hear me, Mr. Anthony? Okay, if not, Esther, you can go ahead.
Okay, sir. Indemnification asset. The seller in a business combination may contractually indemnify the acquirer for the outcome of a contingency or certainty related to all or parts of the specific asset or liability. For example, the seller may indemnify the acquirer against loss above a specific amount of a liability arising from a particular contingency. In other words, the seller will guarantee that the acquirer's liability will not exceed a specified amount. As a result, the acquirer obtains an indemnification asset. The acquirer shall recognize an indemnification asset at the same time that it recognizes the indemnified item measured on the same basis as the indemnified item, subject to the need for evaluation allowance for uncollectible amounts. Therefore, if the indemnification relates to an asset or a liability that is recognized at the acquisition date and measured at its acquisition date fair value, the acquirer shall recognize the indemnification asset as the acquisition date measured as its acquisition date fair value. For indemnification asset measured at fair value, the effect of uncertainty about future cash flow because of collectability considerations are included in the fair value measurement, and a separate valuation allowance may not be necessary. The technical note here, at the end of each subsequent reporting period, the acquirer shall measure the indemnification asset that was recognized at the acquisition date on the same basis as the identified liability or asset, subject to any contractual limitations on its amount, and for an indemnification asset that is not subsequently measured at its fair value. Management assessment of the collectability of the indemnification asset. The acquirer shall recognize the indemnification asset only when it collects the asset, sells it, or otherwise loses the right to it. Intangible assets. The acquirer in some instances may have intangible assets such as development costs of software and other development expenditure. These can be recognized separately from goodwill only if they are identifiable. An intangible asset is identifiable only if it meets a separability criterion. The intangible asset is capable of being separated or divided from the entities that holds it and sold, transferred, licensed, rented, or exchanged, regardless of the acquirer's intent to do so. An intangible asset meets this criterion, even if its transfer would not be a loan. but instead would be accompanied or bundled with a related contract, other identifiable asset or a liability, legal or contractual criterion. The intangible asset results from contractual or other legal rights. An intangible asset meets this criterion even if the rights are not transferable or separable from other rights and obligations of the acquiree. IFRS 3 reverse organizes group of identifiable intangible into categories related to or based on marketing related, customer or client related, artistic work related, contractual related, and technological related intangible assets.
Okay, thank you. Now, let me start with identification asset. What it means is this. You know, in the process of acquiring a company, when you do due diligence, there's no amount of due diligence you do except if the target entity is widely opened, transparent, and they have quality reporting system, and they don't have things that are not probably visible to them also, that you will not carry a risk of possible exposure to what you don't envisage by the time you take over a company. And that's why it's now a common practice that where you still have some doubts, especially when it relates to contingencies, you might put a clause in your acquisition that will trigger a possible claim in case it crystallizes. What does that mean? Remember that if you buy a company, even liability that was not known to you, that somebody might come up and say in 5 years ago, so happened that I'm now seeing that I have a cancer from consuming your product. Whereas you are a new person buying a company, but the liability is on the company and the company is continuous, which means it's continuous in nature, regardless of change of ownership. And this is not envisaged even to the seller as at the time of that, or it's not to the seller, but the seller just tries to hide such information. And peradventure, by court order, court found the company liable, and the company has to pay damages of 10 million naira, which means it's a liability that was not captured, but it's something that can crystallize. Now, because of you cannot predetermine to what degree such things might happen in the future, or there's a promise from the presentation, the investment memorandum, and the likes from the seller, saying that this company has this potential of this, and that. And on that basis, they are valuing the company as so much and they are pricing it as so much. And you are not convinced enough. What then do you do is that you put a clause, which you call indemnification clause, in your closeout contract to say that peradventure, these your promises does not tend to materialize, or liability that were not envisaged crystallizes, which is not as a result of we, but as a result of your own operation in those days. Therefore, such liability, since it is onerous on us to meet, we have the ability to reclaim this thing back from you. Therefore, this brings about indemnification assets. The question then is, the standard is saying, if you can recognize a contingent liability as a result of this, therefore you should be able to recognize the indemnification asset. And you are going to recognize them in similar fashion by measuring them at acquisition date fair value. But if such contingent liability is difficult for you to reliably measure at fair value, which then means that the indemnification asset will equally not be recognized, but will only be disclosed along the line. But the question then is, wherever you have it practicable to estimate at fair value at acquisition dates any possible losses or liability that may crystallize as a result of this acquisition, and of which you have the indemnification asset for, you should be able to also measure that indemnification asset at the acquisition date fair value. Okay, and the only time you recognize the indemnification asset is when you have collected the proceeds of that asset, or you have sold the assets, peradventure transfer it to somebody else and take up a benefit, or the right to those assets no longer exist. Okay. Now, intangible asset is intangible asset, as we are going to discuss under IS 30. That's IS 38. We'll discuss that extensively under IS 38, and we are always aware that there are two criteria that should be met whenever we are discussing on intangible asset recognition. And the first criteria is separable, which means it was what you can identify separately from other assets, okay? And the second one is the legal criterion, which means it's what you have a legal right over, whether by way of acquisition, registration, or the likes. Okay. Now I want somebody to volunteer to discuss on goodwill.
Goodwill and impairment. Goodwill arising on consolidation is subjected to an annual impairment review, and impairment may be expressed as an amount or a percentage. Goodwill should be carried in the statement of financial position as cost less any accumulated impairment losses. Adjustment after the initial accounting is complete. In some situations, the fair value of the acquired identifiable assets, liability, and contingent liabilities, or the cost of the combination can only be determined provisionally by the end of the period in which the combination takes place. In this situation, the acquirer should account for the combination using those provisional values. The acquirer should recognize any adjustment to those provisional values as a result of completing the initial accounting. A, within 12 months of the acquisition date, and B, from the acquisition date, that is retrospectively. This means that A, the carrying amount of an item that is recognized or adjusted as a result of completing the initial accounting shall be calculated as if its fair value at the acquisition date had been recognized from that date. B, goodwill should be adjusted from the acquisition date by an amount equal to the adjustment to the fair value of the item being recognized or adjusted. Any further adjustment after the initial accounting are complete should be recognized only to correct an error in accordance with IS 8, accounting policies changing in accounting estimates and errors. Any subsequent changes in estimates are dealt with in accordance with IS 8, i.e. the effect is recognized in the current and future periods. IS 8 requires an entity to account for error correction retrospectively and to present financial statement as if the error had never occurred by restating the comparative information for the prior periods in which the error occurred. Technical notes. Please scroll down, sir. IS 36, impairment of assets, requires a subsidiary's full goodwill impairment to be allocated between the parent and the non-controlling interest on the same basis as the subsidiary's profits and losses are allocated. Although it could be argued that this requirement depicts anomaly, but in this context, the impairment of goodwill on consolidation is to be allocated proportionately, even if the contribution to full goodwill by the non-controlling interest is not itself proportionate. Measurement period. If the initial accounting for a business combination is incomplete by the end of the reporting period in which the combination occurs, the acquirer shall report in its financial statement provisional amounts for the items for which the accounting is incomplete. During the measurement period, the acquirer shall retrospectively adjust the provisional amounts recognized at the acquisition date to reflect new information obtained about facts and circumstances that existed as of the acquisition date, and if known, will have affected the measurement of the amount recognized as of that date. During the measurement period, the acquirer shall also recognize additional assets or liabilities if new information is obtained about facts and circumstances that existed as of the acquisition date, and if known, will have resulted in the recognition of those assets and liabilities as of that date. The measurement period ends as soon as the acquirer receives the information it was seeking from facts and circumstances that existed as of the acquisition date, or learns that more information is not obtainable. However, the measurement period shall not exceed 1 year from the acquisition date. Technical note. The measurement period is the period after the acquisition date during which the acquirer may adjust the provisional amount recognized for a business combination. The measurement period provides the acquirer with a reasonable time to obtain the information necessary to identify and measure the following as of the acquisition date in accordance with the requirements of IFRS 3. 1. The identifiable assets acquired, liability assumed, and non-controlling interest in the acquiree. 2. The consideration transfer for the acquiree or the other amount used in measuring goodwill. 3. In a business combination achieved in stages, the equity interest in the acquirees previously held by the acquirer. And lastly, the resulting goodwill or gain on a bargain purchase. Reacquired rights. The acquirer shall measure the value of a reacquired right recognized as an intangible asset on the basis of the remaining contractual term of the related contract, regardless of whether market participants would consider potential contractual renewals when measuring its fair value. Technical note. A reacquired right recognized as an intangible asset shall be amortized over the remaining contractual period of the contract in which the right was granted. An acquirer that subsequently sells a reacquired right to a third party shall include the carrying amount of the intangible asset in determining the gain or loss on the sale. Reverse acquisitions. IFRS 3 also addresses a certain type of acquisition known as a reverse acquisition or takeover. This occurs when a company, hypothetically called Success PLC, acquires ownership of another company, hypothetically called Dynamic Limited, through a share exchange. For example, a private entity may arrange to have itself acquired by a smaller public entity as a means of obtaining a stock exchange listing. The number of shares issued by Success PLC as consideration to the shareholders of Dynamic Limited is so great that control of the combined entity after the transaction is with the shareholders of Dynamic Limited. In legal terms, Success PLC may be regarded as the parent or controlling entity. But IFRS 3 states that as it is dynamic limited shareholders who control the combined entity, dynamic limited should be treated as the acquirer. Dynamic limited should apply the acquisition of full consolidation method to the assets and liabilities of Success PLC. Furthermore, reverse acquisition sometimes occur when a private operating entity wants to become a public entity, but do not want to register its equity shares. To accomplish that, the private entity will arrange for a public entity to acquire its equity interest in exchange for the equity interest of the public entity. In this example, the public entity is the legal acquirer because it issued its equity interest, and the private entity is the legal acquiree because its equity interests were acquired. However, application of the guidance in the standard IFRS 3 results in identifying A, the public entity as the acquiree for accounting purposes, the accounting acquiree, and B, the private entity as the acquirer for accounting purposes, the accounting acquirer. Technical notes: the accounting acquiree must meet the definition of a business for the transaction to be accounted for as a reverse acquisition, and all of the recognition and measurement principle in IFRS 3, including the requirement to recognize goodwill, apply.
Thank you very much, sir. Thank you very
You're
much, sir.
welcome.
Yeah, now let's go back. Now, we've discussed goodwill and impairment. We've demonstrated our understanding on it, but I want to speak to this aspect of adjustment after initial accounting is complete. And I will link it up with this measurement period. But let me start with measurement period. Measurement period is a period of 12 months from the date of acquisition to the next 12-month calendar. This period is given as an allowance to ensure that the new owners have settled down and they have been able to justify truly that those assets and liabilities exist in that amount and some other things like that. All because one thing that is the reality is that no matter how honest the sellers are, sometimes until you take ownership, until you take over control, until you take over operation before you see things visibly, which that means that what you might have considered as asset identifiable or liabilities identifiable might not necessarily be, or you might see some other assets unveiled that were not captured before, and most especially liabilities that were not captured, which means the standard allows a period of 12 months because anything you can't do to establish what your fit is in 12 months, I don't think you can do it in 24 months or thereafter. And I think that is the rationale behind that measurement period of 12 months to say, even though in the interim, based on information presented before me and due diligence, I'm able to identify that these are the assets and liabilities and probably have identified what my goodwill is supposed to be. But upon the immediate 12 months, we are able to establish and concretely, reasonably identify what all the assets is and you have measured them at fair value. If they are materially different from what you have seen before, it then means that the goodwill you had before is not appropriate, it's not the correct goodwill. Therefore, you are allowed to go back and readjust for what your goodwill is supposed to be, or your gain of bargain purchase is supposed to be, based on the facts you now have within the next 12 months. But the fact you are talking about is of what existed as an acquisition, only that you are now having more information now to know the true position as at then, not facts as a result of new development that has happened after acquisition. No, it is what existed as an acquisition, which then means that any adjustment to goodwill arising from the fact you have obtained now based on what existed prior to acquisition will constitute a measurement period adjustment against goodwill or gain or bargain purchase. But if it is anything thereafter, which is what we are talking about here, adjustment after initial accounting period is complete, which is the measurement period is complete, nothing again like provisional value. It then means that those constitute post-acquisition activities, okay? And that's what we are trying to say, which means immediately you are acquiring a company, every value is considered provisional until you substantiate them. Since you are now on the field, you have control, there's no restriction, you can verify, you can review, and you can evaluate. And at that point in time, you can go back and change those provisional values to values that are valid. Okay, but once that 12-month period has completed, or within that 12-month period, once it's established that it's as a result of new development, such will not require an adjustment to your goodwill or gain or bargain purchase. And that's what it means, which means I've been able to explain both the measurement period and the adjustment to goodwill or whatsoever it is once the accounting period has complete. Okay, now reacquired right, as we have mentioned earlier, if you have any right that has been reacquired, you have to recognize that right based on what you have paid for it. Okay, and you are expected that such rights have to be amortized because most of those rights are intangible assets, as the case may be. You have to more or less amortize it over the remaining contractual life of that right, okay, which is very straightforward. And peradventure, before the life of that asset expires, you dispose it of, the remaining kind amount will be compared with any sales proceed to determine whether there's a gain or loss on the disposal of such a reacquired right. Now, the other aspect is reverse acquisition. All what we know is acquisition, whereby the legal acquirer is also the accounting acquirer, and the legal acquiree is also known as the accounting acquiree. But when it comes to reverse acquisition, you'll find out that the legal acquirer is usually the accounting acquiree, while the legal acquiree is usually the accounting acquirer. And what is that? The only time you can have reverse acquisition based on experience is through share exchange. And it's a strategy that is common, which I've also involved in one way or the other. For example, in most jurisdictions, even in Nigeria until recently, you find out that for you to have your company that was once a private company listed is a tall order. There are a lot of conditions and requirements involved. One, you can't start a business in 1 or 2 years and say you want to list. No. The minimum period before now in Nigeria and in most other jurisdictions is a period of 3 to 5 years or more. And also, there are also prerequisites, even when you have been in business for years, that you must do. And all of this does not allow a company to get listed easily or take opportunity of the timing. Therefore, the easiest way out when you compare various strategies is that you look for a company in the capital market. Smaller company, you don't look for big cheap or big company because your objective is not necessarily to take over the operation of that company because it's not valuable. Your objective is that you want to take opportunity of that company already being listed in the capital market. Therefore, what do we do? If I find, let me say, the smallest company in Nigerian Stock Exchange, I will approach the owner. I will say, okay, can we go into a share exchange whereby you will present yourself as if you are acquiring me? And the only mode of acquisition will be that we exchange shares, which means you issue your shares in exchange for my own shares, so that at the end of the day, you that you are acquiring me, your net worth is 10 billion. Me that you are acquiring, my net worth is 15 billion. By the time you do share exchange, it's so that I'll be carrying like 80% of your shares, and you now carrying 20%. Before you know, we've subsumed one another by way of merger scheme, and you see that that small company now become a big company. In a matter of weeks, months, or days, we now unveil change of name. Before you know, that limited company that was outside before is already inside as a PLC. Have you ever come across such strategy before from your experience? Has anyone come across such strategy before? I want us to share our understanding here. Someone. Your network is bad. Your network is bad. You can contribute with a chat. Any other person other than someone?
From the explanation, sir.
Any other person other than someone? Okay, let me show you what reverse takeover in a video here. Hold on, let me share it.
Hi guys, here's Hustle Hub. Today we're going to talk about reverse takeover. A reverse takeover, also known as a reverse merger or reverse IPO, is a process used by privately held companies to go public, and it differs from the common initial public offering process. We also made a video about the IPO process, so make sure to check it out as well. In order to have a reverse takeover, a privately held company buys a controlling stake in a publicly traded company. After that, the shareholders in the privately held company exchange their stocks with the publicly traded company's stock. Once this transaction is done, the company that was previously private can be traded on a public stock market. The difference between a reverse takeover and a traditional IPO is that the first process is much faster and cheaper. It takes just a few weeks to complete a reverse takeover, rather than months or even years for a traditional IPO. In a reverse takeover, the company that wants to go public doesn't have to find investors in the company. In a traditional IPO process, the company has to pitch various investors to buy into the company. If a company goes public through a reverse takeover, doesn't have to comply with all the policy guidelines that authorities like the Securities and Exchange Commission put when companies go public through an IPO. That's also why companies that go public through a reverse takeover have a higher chance to go bankrupt compared to companies that use traditional IPOs. Reverse takeovers can be easily used by foreign companies to access the US capital markets. Even if most companies go public through a traditional IPO process, there are some very well-known names that used this process. The first is Dell. This tech company got public through a reverse takeover with VMware. Another notorious reverse takeover was Warren Buffett's Berkshire Hathaway. Buffett held a private partnership and used its capital to buy a controlling stake in the textile manufacturer Berkshire Hathaway. After that, Buffett sold all the textile facilities and reinvested the capital. On the other side, many shady companies used this process to access the public markets and fraud the public sometimes. This happened, for example, with the many Chinese companies that used the reverse takeovers to access the American market and defraud investors. This was explained in the Netflix documentary called China Hustle. Thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.
Now, do you find it interesting? Okay, now somebody asked me a question. He said, can we relate it to the case of Titan Trust and Union Bank? Yes, it's also possible. I think Titan Trust is a limited company and Union Bank is quoted, and therefore it can also be a strategy. And whereby, as Titan Trust is said to have purchased or acquired Union Bank, it can now merge it and subsume itself within Union Bank and more or less just do a change of name. And that's just all. It's a strategy. And majorly, as I've explained earlier, and also as you have watched in the video, we find out that it's a good strategy that is easy for a company to get listed, fast, cheaper, but it comes at a cost also, because the company you have more or less acquired or merged with, in order to enter the market, you don't know the level of contingency is carried or toxic asset is carried, which might subsume you if care is not taken. Unlike if you go on your own and you know what your worth is and your exposure is at that point in time. Okay, to also move further, somebody asked me with respect to, someone asked me, could you please help expatiate on the concept of an onerous contract in relation with acquisition? And he also further said it's actually about the onerous contract you mentioned earlier while explaining identification asset. I just want to be enlightened about how onerous contract applies in acquisition of subsidiaries. Now, the first thing is that I didn't more or less refer to onerous contracts. I only make reference to an adjective, which is if it becomes onerous, okay? Even though they have resemblance. What I'm trying to say is this: because you have contingent liability or a liability that you have to take responsibility for, even when it is not you, but because of the company principle that it is a continuum, which means it's something that must be continuous regardless of change in ownership, it now becomes a liability you must carry. It makes it onerous on you. And the word onerous means that it's an unavoidable obligation that outweighs any benefit associated with it, which also is similar to when we talk about onerous contracts. When we get to IAS 37, we'll discuss extensively on onerous contract when it comes to provision and contingent liabilities. Does that answer your question? I guess it is. Now, to wrap it up, we have the aspect of contingent liabilities. Spin-off, reverse spin-off. I will take it off from there. Okay, who will volunteer at this point?
IAS 37, contingent liability. IAS 37, provisions, contingent liabilities, and contingent assets. Defines a contingent liability as a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entity, or the present obligation that arises from past event but is not recognized because it is not provable that an outflow of resources embody economic benefit. Can you hear me?
Yes, we can hear you.
A present obligation that arises from past event but is not recognized because, one, it is not probable that an outflow of resources embodying economic benefit will be required to settle the obligation, or two, the amount of obligation cannot be measured with sufficient reliability. The requirements in IAS 37 do not apply in determining which contingent liability to recognize as of the acquisition date. Instead, the acquirer shall recognize as of the acquisition date a contingent liability assumed in a business combination if it is the present obligation that arises from past event and its fair value can be measured reliable. Therefore, contrary to IAS 37, the acquirer recognizes a contingent liability assumed in business combination at the acquisition date, even if it is not provable that an outflow of resources embodying economic benefit will be required to settle obligation. After initial recognition and until the liability is settled, cancelled, or expired, the acquirer shall measure the contingent liability recognized in a business combination at the higher of the amount that will be recognized in accordance with IAS 37 and the amount initially recognized, less, if appropriate, cumulative amortization recognized in accordance to IAS 18 revenue or IFRS 15 if early adopted. Technical notes. This requirement does not apply to contracts accounted for in accordance with IFRS 9 and IAS 39. Spin-off. This entails the creation of an independent entity through the sale or distribution of new shares of an existing business division of a parent company. This occurs occasionally when an entity disposes a wholly or partly owned subsidiary or an investee by transferring its unilateral to the entity shareholders. Special purpose entity is an entity created to accomplish a narrow and well-defined objective, e.g., to lead research and development activity, or a secularization of financial assets, which can be a corporation, trust, partnership, or unincorporated entity. Reverse spin-off. It entails a spin-off transaction in which is nominal or legal spin-off is to accounted for as the spine in order to reflect the economic reality of the spin-off transaction.
Okay,
I'm done.
thank you very much. Now, let's start with contingent liability. Now, naturally, as I've explained earlier, that contingent liability should not be recognized in line with IAS 37. But there's an exception to that rule when it comes to business combination, and the exception is obtained from IFRS 3 that says that contingent liability, especially if it's a present obligation, which is far away from possible obligation, because it can come by way of possible obligation, which is extreme, and it can come by present obligation, which is closer to becoming a liability only for you to be able to meet one or two things. Now, when it's much more of a present obligation, and it is an obligation that you can more or less take over as part of your liability, especially when there's an indemnification asset clause involved, such contingent liability may be recognized once you can reliably measure it at fair value at the acquisition date. And in doing so, you recognize as fair value at acquisition date as part of your liability you assume. Okay? In that case, the process of recognition will bring about a reduction in your retained earnings. And invariably, what that means is that you are now taking over a liability that was once contingent as a full-fledged liability. And forthwith, when you are to recognize it subsequently, you recognize that contingent liability recognized as a result of business combination at the higher of what you will have recognized under IAS 37, which might be zero, because IAS 37 may not warrant you to recognize it, or might be any amount if it now moves away from contingency to a provision, which you will have estimated based on best estimate. And is the higher of that, and what you'll have recognized based on the fact that we are now using the IFRS 15, less any portion of it that you have amortized out as an income. But what we are just trying to say here is that, as opposed to the general philosophy and understanding that contingent liability is not recognized, but when it comes to business combination, once certain conditions are met, especially with respect to the fact that one is a present obligation, and two, it's what you can reliably estimate as the acquirer at fair value at the point of acquisition, such recognition is required. And when we talk about spin-off and the likes, what we are trying to say is this: whenever you acquire a company, the company might have different product lines or business divisions. And your strategy to managing the company and taking it to the next level might be that you want to do away with some of these product lines or divisions. Therefore, you cut them out. We call it carve out. You carve them out and dispose them of. The process of doing that is what we call spin-off. Okay, and also you can have a reverse spin-off. Do you guys see now? Which means it entails when you spin off transaction in which the nominal or legal spin-off is to be accounted for as a spine in order to reflect economic reality, which means you now create a spin-off and you create that as a separate vehicle. which may now become a subsidiary of the immediate entity that you are now taking it out of, or structure is a form of management strategy towards optimizing value and creating efficiency. And the general word for XPE, or what we call SPV, special purpose entity or special purpose vehicle, which in America, some people call it variable interest entity, VIE, is more or less an entity that you create for special objective. And usually they are incorporated, but it doesn't stop it from not being incorporated. Non-incorporated means that it can be an enterprise, or it can be a partnership, or a trust under a trust deed. But what we are trying to say here is that this is an entity that is not necessarily in operation, but the objective of them is to capture an opportunity or use them for structured transaction in the course of business combination or acquisition. Okay, that is that. Now, we've come to an end to discuss this. And the other aspect is what we have known to do. And I think I want Mr. Demi, I want to listen to his voice again to take us through this and reiterate all what we have done with respect to accounting for business combination, especially at the point of acquisition using the acquisition methodology. Over to you, sir.
Yes, sir. Accounting for business combination acquisition method. IFRS 3 requires the accounting for the business combination to be based on acquisition method, formerly termed the purchase method, by the acquirer or investor. The change in terminology, that is nomenclature, emanated from the emphasis made by IFRS 3 as revised, that a business combination can occur even when a business transaction is not involved. Acquisition method involves applying the following steps. 1, identification of the acquirer. 2, determination of the acquisition date, also the date of inclusion. 3, recognition and measurement of identifiable tangible and intangible assets acquired and liability assumed. 4, identification of assets and liability requiring a separate accounting. 5, classification or designation of identifiable assets acquired and liabilities assumed. 6, recognition and measurement of any non-controlling interest in the acquiree, i.e. the subsidiary. 7, measurement of the consideration transferred. And lastly, recognition and measurement of goodwill or gain on bargain purchase, i.e. the negative goodwill. Steps in acquisition method accounting of business combination. Step 1, identifying the acquirer. For each business combination, one of the combining entities shall be identified as the acquirer. The acquirer is the entity that obtains control of another entity, i.e. the acquiree. Step 2, determining the acquisition date. The acquirer shall identify the acquisition date, which is the date on which it obtains control of the acquiree. The date on which the acquirer obtains control of the acquiree is generally the date on which the acquirer legally transfers the considerations, acquires the assets, and assumes the liabilities of the acquiree, the closing date. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. For example, the acquisition date precedes the closing date if a written agreement provides that the acquirer obtains control of the acquiree on a date before the closing date. An acquirer shall consider all pertinent facts and circumstances in identifying the acquisition date. Step 3, recognition and measurement of identifiable tangible and intangible assets acquired and liability assumed. As of the acquisition date, the acquirer shall recognize separately from goodwill the identifiable assets acquired, the liability assumed, and any non-controlling interest in the acquiree. To qualify for recognition as part of applying the acquisition method, the identifiable asset acquired and liability assumed must meet the definition of asset and liability in the framework for the preparation and presentation of financial statements at the acquisition date. For example, cost the acquirer expects but is not obliged to incur in the future to effect its plan to exit an activity of an acquiree or to terminate the employment or relocate an acquiree's employees and not liabilities at the acquisition date. Therefore, the acquirer does not recognize those costs as part of applying the acquisition method. Instead, the acquirer recognizes those costs in its post-combination financial statements in accordance with other IFRS. Step 4. The acquirer shall measure the identifiable asset acquired and the liability assumed at the acquisition date fair value. For each business combination, the acquirer shall measure at the acquisition date components of non-controlling interest in the acquiree that are present ownership interests and entitle their holders to a proportionate share of the entity's net assets in the event of liquidation at either Roman figure 1 fair value or Roman figure 2 the present ownership instrument proportionate share in the recognized amount of the acquiree's identifiable net assets. All other components of NCI shall be measured at the acquisition date fair value unless another measurement basis is required by IFRS. Technical notes. In addition, to qualify for recognition as part of applying the acquisition method, the identifiable asset acquired and liability assumed must be part of what the acquirer and the acquiree or its former owners exchanged in the business combination transaction rather than the result of separate transactions. Step 5. Identification of assets and liabilities requiring separate accounting. The acquirer's application of the recognition principle and conditions may result in recognizing some assets and liabilities that the acquiree had not previously recognized as assets and liabilities in its financial statement. For example, the acquirer recognizes the acquired identifiable intangible assets, such as a brand name, a patent, or a customer relationship that the acquiree did not recognize as assets in its financial statement because it developed them internally and charged the related costs to expense. Step 6. Classification of designation of identifiable assets acquired and liability assumed. The acquirer shall make those classifications or designations on the basis of the contractual terms, economic conditions, its operating or accounting policies, and other pertinent conditions as they exist at the acquisition date. In some situations, IFRS provide for different accounting depending on how entity classifies or designates a particular asset or liability. Example of classifications or designations that the acquirer shall make on the basis of the pertinent conditions as they exist at the acquisition date include but are not limited to 1. Classification of particular financial assets and liabilities as a financial asset or liability at fair value through profit or loss, or as a financial asset available for sale or held to maturity in accordance with IS 39, Financial Instrument Recognition and Measurement. 2. Designation of a derivative instrument as hedging instrument in accordance with IS 39. And 3. Assessment of whether an embedded derivative should be separated from the host contract in accordance with IS 39, which is a matter of classification, as this IFRS uses that term. Exceptions to the aforementioned principles include 1. Classification of a lease contract as either an operating lease or a finance lease.
Okay, before you go, okay,
All right,
now, as at the time this book was written, IFRS 9 has not taken effect. Okay, now, when you see IFRS 39, your reference will always be to IFRS 9. Take note of that, please. Are you getting it? And 2, there's no classification under IFRS 9 that is financial asset available for sale or held to maturity. Rather, the classification you have, in addition to fair value profit or loss, are fair value through other comprehensive income, which replaces this financial assets available for sale, and also amortized cost, which replaces the held to maturity. We're going to discuss all of those things extensively when we get to IFRS 9 under financial instrument. But you can continue. Can we start from exceptions to the aforementioned principles? Can you repeat it?
Okay, sir. Exceptions to the aforementioned principles include classification of a lease contract as either an operating lease or a finance lease in accordance with IS 17 leases.
And also, as you are aware, effectively in the last 2 years, IFRS 16 has come to replace IAS 17, which means leases is only classified with respect to operating and finance from the angle of the lessor, while from the angle of the lessee, there's no longer classification. It's a single economic model. We are going to discuss that when we get to IFRS 16 leases. Also, with reference to IAS 17, just think it through in today's world as IFRS 16. Okay, continue.
2, classification of a contract as an insurance contract in accordance with IFRS 4 insurance contracts. The acquirer shall classify those contracts on the basis of the contractual terms and other factors at the inception of the contract, or if the terms of the contract have been modified in a manner that would change its classification at the date of that modification, which might be the date of acquisition. 7, recognition and measurement of any non-controlling interest in the acquirees, i.e. the investee. The acquirer is required to measure any NCI in the acquiree at either of 1, acquisition date fair value, or the proportionate share of the identifiable assets acquired and liability assumed at of the acquisition date, i.e. measure at the share of acquisition date net asset. Technical note: a parent shall present NCI in the consolidated statement of financial position within equity, separately from the equity of the owners of the parent. Step 8, measurement of the consideration transferred. The acquirer shall measure consideration as of the acquisition date as the aggregate of Roman figure 1, the consideration transferred measured in accordance with IFRS 3, which generally requires acquisition date fair value. 2, the amount of any NCI in the acquiree measured in accordance with this IFRS. And 3, in a business combination achieved in stages, the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. Step 9, recognizing and measuring goodwill or gain from a bargain purchase. The acquirer shall recognize goodwill as of the acquisition date measured as the excess or consideration transferred or transferable, and the net of the acquisition date amount of the identifiable assets acquired and the liability assumed measured in accordance with IFRS 3. Otherwise, where the goodwill is negative, gain on bargain purchase transaction is recognized in profit or loss of the group upon acquisition.
Okay, thank you very much. Thank you. Now,
You're welcome.
in addition to that, I'm going to more or less play a video to buttress, interestingly, reverse acquisition, because again, part of the value we professional accountant and finance professionals have to put on the table goes beyond just reporting. You are supposed to be a value driver for a business, updating them on strategies to optimizing value and to creating competitiveness and sustainability within your business. Okay, in this slide, we look at this video and we'll tend to appreciate it more.
I'm attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the first segment in a multi-part securities law cast discussing reverse merger transactions. What is a reverse merger? A reverse merger is the most common alternative to an initial or direct public offering for a company to go public. A reverse merger allows a private company to go public by acquiring a controlling interest in a public operating or shell company. The SEC defines a shell company as a publicly traded company with no or nominal operations and either no or nominal assets or assets consisting solely of cash or cash equivalents. In the reverse merger process, the private operating company shareholders exchange their shares of the private company for new shares of the public company so that at the end of the transaction, the shareholders of the private or formerly private company own a majority of the public company, and the private company has become a wholly owned subsidiary of the public company. At the closing, the private company has gone public by acquiring a controlling interest in a public company. For tax reasons, a reverse merger is sometimes structured as a reverse triangular merger, where the public company forms a new subsidiary to complete the transaction with the private company. The end result is the same. The private company shareholders own a majority of the public company, and the formerly private company is now public. The public company must file a Form 8K with the SEC reporting the reverse merger transaction. Where the public company was a shell company, i.e. not operating, that Form 8K contains Form 10 registration information and is commonly referred to as a Super 8K. Like any transaction involving the sale of securities, the issuance of securities to the private company shareholders must either be registered or exempted from registration. Generally, the issuance relies on either Section 4A2 or Rule 506 for such exemption. A reverse merger is a merger transaction, with the difference being that the target company, the private company, ultimately ends up owning a majority of the acquiring company, i.e. the public company shell. Generally, the first step in a reverse merger transaction is to execute a confidentiality agreement and a letter of intent. The initial confidentiality agreement will contractually bind the parties to keep all information confidential so that due diligence can be exchanged. It also may contain provisions prohibiting solicitation of customers, suppliers, or otherwise prohibit the use of the proprietary information learned in the due diligence process. It also may contain standstill and exclusivity provisions so that the parties don't concurrently negotiate with other parties for the same or similar transactions. The letter of intent, or LOI, is generally non-binding and spells out the broad parameters of the transaction. The LOI helps identify and resolve key issues in the negotiation process and hopefully narrows down outstanding issues prior to spending the time and money conducting in-depth due diligence and drafting the transaction documents and supporting documents. Along with an LOI, the attorneys prepare a transaction checklist, which includes a to-do list and a who-do list for each of the to-do items. Following the LOI, the parties will prepare a definitive agreement. The next securities law cast in this series will pick up discussing the definitive agreement used in the reverse merger transaction. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance. Should you have any questions about any of the information we've just covered, please visit securities. I'm attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the final segment in a multi-part securities law cast discussing reverse merger transactions. Today I will talk about the advantages and disadvantages of completing a reverse merger. First, the advantages. The primary advantage of a reverse merger is that it can be completed very quickly. As long as the private entity going public has its ducks in a row, a reverse merger can be completed as quickly as the attorneys can complete the paperwork. Having your ducks in a row includes having all the information to complete a Super 8K organized and available, including completed audited financial statements for the prior 2 fiscal years and reviewed financial statements for the quarters to date, or from inception if the company is less than 2 years old. Another benefit is the existence of a shareholder base. A shareholder base is necessary for a company to have active trading and attractive liquidity in its stock. The more shareholders, generally the more active the trading in the stock and the less volatile the stock price is from ordinary buying and selling pressure. In addition, a minimum number of shareholders, generally 300, is necessary to qualify to list on an exchange such as NASDAQ. Also, existing shareholders are often an overlooked but great source for capital raises via shareholder rights offerings. Another benefit is the existence of a trading symbol. Generally, in an IPO process, a trading symbol is not issued until the S1 process has been completed and closed out, and a market maker completes a 15C211 application with FINRA. The 211 process can be lengthy and difficult. A trading symbol is a necessary precondition to a secondary trading market and a precondition for many active capital investors. Similarly, a trading history can be seen as beneficial. Although really any pre-reverse merger trading history should not be indicative of future trading activity, it does show how active the public vehicle shareholder base is and was, and experience shows that it is infinitely easier for an active trading market to develop where one has previously existed. Finally, since a reverse merger is a going public transaction, the newly public vehicle or newly public company will have all the benefits of being public, including the ability to use stock and stock options to attract and keep higher level executives, use stock as currency to make acquisitions, and of course to access capital markets and capital investors. Now the disadvantages of a reverse merger. The primary disadvantage is the restriction on the use of Rule 144 where the public company is or ever has been a shell company. Rule 144 is not available if the public vehicle is a shell company until 12 months after the filing of the Super 8K, and then only if the company is current in its reporting obligations. Even if the public vehicle is not a shell at the time of the reverse merger, if it ever was a shell in its history, it carries the stigma forever, and Rule 144 will only be available if the company is current in its reporting obligations. Of course, there is also the issue of undisclosed potential liabilities, lawsuits, or other issues with the public shell. Accordingly, due diligence is an important aspect of the reverse merger process, even dealing with a fully reporting vehicle. The third primary disadvantage is the reverse merger is not a capital raising transaction, whereas an IPO and DPO are. An entity in need of capital will still be in need of capital following a reverse merger. The next disadvantage is the immediate cost. The private entity generally must pay for the public shell with cash, equity, or a combination of both, and I've covered that in a previous lawcast. The next disadvantage is a trading history, which I mentioned as an advantage. An inactive or volatile trading history can repeat itself, just as an active and good trading history can repeat itself. The next disadvantage is that the national exchanges, such as NASDAQ, prohibit a reverse merger company from applying to the exchange until the combined entity is traded on the over-the-counter market for at least 1 year following the reverse merger, and the entity must remain current in its reporting obligations for that year. The next disadvantage is dealing with FINRA and DTC. FINRA can be very difficult when applying for a new trading symbol following a reverse merger. Also, concurrently with getting a new trading symbol or a name change, DTC will want an updated eligibility opinion letter, which may not be available if the public vehicle is a shell company. Finally, when an entity seeks to go public through a reverse merger or an IPO, they will be subject to several and ongoing time-sensitive filings with the SEC and will thereafter be subject to the SEC reporting requirements. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance. Should you have any questions about today's topic, please visit securitieslawblog.com or contact me directly. Inquiries of a technical nature are always encouraged.
Okay, to wrap up this, I want somebody to volunteer and read out the summary of all what we have discussed today as we have a closure. Thank you.
Summary of Chapter 2. A group is considered to comprise of parent and subsidiary. A parent is the business entity that controls the financial and operating policies of the other entity, that is the subsidiary. The subsidiary is seen as the business entity that is susceptible to the control of the parent entity. 2. Whenever a group exists, there is responsibility saddled with the parent. Saddled with the parent to prepare group accounts. Group accounts are accounts of the parent and its subsidiaries, as if they are account of a single economic entity. The starting point of preparing group accounts is the first day the parent obtains control of the subsidiary. 5. The parent ceases to prepare group account only when it no longer has control over the financial and operating policy of the subsidiary. Invariably, when control of subsidiary is lost or deemed to be lost. 6. Acquisition date is the date on which the acquirer obtains control of the acquiree. 7. Non-controlling interest represents the stake in the subsidiary other than that of the parent. 8. Control represents the power over the investee, the exposure or right to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's return. 9. Potential voting right may be considered where it is likely other than not that it will be exercised in the immediate future period in assessing the existence of control in an acquisition. 10. Acquisition-related costs are either expensed in profit or loss. If they do not relate to issues of shares or debt instruments. And where acquisition-related costs are attributable to issues of shares, issues of debt instruments, such costs are used to reduce the proceeds on equity instrument and debt instruments in accordance to the requirement of IAS 32 and IAS. Please, can you take it up? 39, IFRS 9 respectively. 11. The acquisition method of accounting a business combination may result in either a positive goodwill, that is partial or full goodwill, or negative goodwill, which results in a gain or bargain purchase. 12. The allowance is provided for the acquirer in a business combination to adopt provisional value in the accounting for business combination within the first 12 months of acquisition, termed the measurement period. While subsequent adjustments within that period is permitted to restate the acquisition date, accounting which may affect goodwill or gain or bargain purchase. 13. Where fair value is obtained after the elapse of measurement period, that is grace period, the requirement of IAS 8, accounting policy, estimates and error may apply. 14. Provisional value are either the carrying amount or other equivalent measure other than the fair value, which is adopted as a surrogate for the acquisition date fair value. 15. Non-controlling interest can either be accounted for at the proportionate share of the identifiable net assets of the subsidiary at acquisition date or at the acquisition date fair value of the equity instrument of the subsidiary. 16. Losses of the subsidiary can no longer be absorbed wholly by the acquirer or the parent, but such losses attributable to non-controllable should be recognized in full, even if it results in negative amount. Invariably, non-controlling interest can be negative and accounted for within the equity. 17. It is preferable that the parent and subsidiary have the same accounting period, that is, year end, to facilitate seamless process of consolidation. But situations are recognized that may warrant different reporting dates. But the consideration by the standard is such that the difference should not exceed 3 months. A material transaction within 3 months should be adjusted for in a consolidation process. Where the difference in the reporting date is more than 3 months, a reconstruction of the account of the subsidiary to align with the reporting period of the parent will be necessary in order to conform to the requirement of IFRS 10. 18. Before consolidation of the subsidiary accounts with that of the parent, effort should be made to adjust the financial statement of the subsidiary to reflect the accounting policy of the parent, which invariably is the accounting policy of the parent. 19. The reverse acquisition may take place in a situation when the statutory acquirer, based on the legal structuring of the acquisition, later becomes the substantive acquiree. The statutory acquiree now becomes the substantive acquirer. This is much more strategic adopted by non-quoted companies to get listing status in the capital market. 20. There is an exception to the principle of IAS 37 on the recognition of contingent liabilities. Contingent liabilities are not to be accounted for. Rather, contingent liabilities are to be disclosed on the basis of materiality. The exception is in the case of a business combination, as IFRS 2 requires the recognition of contingent liability that arose from a present obligation, of which the fair value can be reasonable and reliable measure or ascertained as an acquisition date. Invariably, such recognition and accounting for contingent liability upon business combination will have effect in measurement of goodwill or gain or bargain purchase transaction. 21. IFRS 10 contains special accounting requirements for investment entity. Where an entity meets the definition of investment entity, see above, it does not consolidate its subsidiary or apply IFRS 3 or business combination when it obtains control or another entity.
Thank you very much. Thank you very much. That is the whole of the summary. And you'll find out that we have extensively discussed some underlying principles and concepts. If you have access to the material, you can also play with the end of chapter questions. And probably, Mr. Adeni, can you read end of chapter question, which you guys can more or less have access to attempt solving them. Over to you, sir.
Yes, sir. End of chapter 2 exercises. Dash exists where one parent consider the parent. Oh, your picture is blocking that, sir.
Okay, can you say it now?
Yes, I can say it now, sir. Controls either directly or indirectly another complaint or the subsidiary. 2, what constitute group account? 3, can a parent company with at least a subsidiary be exempted from preparing group accounts? If yes, kindly illustrate such instances. 4, what basis provides an avenue for the exclusion of a subsidiary from consolidation in group accounts? 5, what is non-controlling interest? 6, are there options to accounting for non-controlling interest upon business combination? Describe, and which option is much preferable? 7, is it arguable that non-controlling interest cannot reflect a negative amount in the consolidated financial position? 8, how are the following acquisition-related costs in business combination treated? A, issue of shares. B, raising of debt instruments. C, those relating to legal, professional, valuation, and accounting services. 9, is it compulsory that the accounting policies and reporting date of the parent and the subsidiary be the same? Elucidate. And 10, describe a reverse acquisition with a practical scenario.
Thank you very much, sir. Thank you very much. Thank you very much. Okay, I believe we are all abreast of what we've discussed so far today. And I've shared the question with you in the notes. And once the video is available, I'll equally share the video with you for you to have better appreciation. Thank you, guys. If there's any other question, otherwise, I might wrap it up with this video. If there's any question, can you guys come up with a question? Any question? Or contribution? Okay, if there's none, I'll wrap it up with this video.
So let's say we just looked at, you can do the filings and all these kind of things, but you can also go public with what's called a reverse merger or reverse takeover, okay, depending on which country you're from. So this is how it works. Let's say we have a company, and the company is called ABC. And ABC is a company that was once successful. It's listed in the stock market. And for some reason, the business model died. And now it has zero money in it. The stock price is at 1 cent, okay, for example. The business failed, okay? The business basically failed, but it's still trading, it's still listed, it's still public, okay? And let's say here you are. Now you have your company, and your company is called, let's say, XYZ Corp, okay? And you have a great project, okay? You have money in the bank. You have a really cool management team. And you have everything that you need to make it successful. Now, what you can do is you can basically do a reverse takeover, which means it's a share exchange. So technically, ABC and XYZ do a one-to-one, let's say, share exchange, where now, if you owned a share of XYZ, you now own 1 share of ABC. And this whole company gets merged into this debt shell, so to speak. Okay, so it gets merged from here into here. So this ABC acquires the company with the money, the projects, and everything. Then ABC gets a name change, gets a management change, and now it's called XYZ. See? Okay, so you can go public immediately. It takes about 30 days, so to speak, but immediately, and you can buy a listed company or listed shell that has been trading in the market. And there's different kind of prices, okay? And the prices vary and so forth. But it's possible that you buy a shell, let's say for $350,000, that's debt, but the shell in itself, just due to the fact that it's actually listed and trading, you buy out all the shares, you pay $350,000, and you go public immediately. Okay, you go public with your concept and you do a reverse merger or reverse takeover. And many people do that, or many companies do that. So instead of going through all the filings and this and that, you can do it, the fast.
Okay.
Good afternoon. My name is.
I believe we appreciate that. And on this premise, we'll call it a day. Thank you very much. And God bless you all.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Yeah, bye.
Thank you, sir.